wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Lying in the long grass, watching as the clouds pass, hands held in silence. Your arms right around me, feeling glad you found me, feeling like I'm home. Wish you would remember April to September, wanting to be near me. Waiting for the sunrise, staring into my eyes, you and I alone. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Lie back in my own dream, play back on a big screen, you and me together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl. drop sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you, I wish that I could tell you, I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Lying in the long grass, watching as the clouds pass, hands held in silence. Your arms right around me, feeling glad you found me, feeling like I'm home. Wish you would remember April to September, wanting to be near me. Waiting for the sunrise, staring into my eyes, you and I alone. I wish that I could tell you, I wish that I could tell you, I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Lie back in my own dream, play back on a big screen, you and me together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you, I wish that I could tell you, I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl give up a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish big screen, you and me together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish dream, play back on a big screen, you and me together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. The nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl. Lie back in my own dream, play back on a big screen, you and me together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a you and me together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Lying in the long grass, watching as the clouds pass, hands held in silence. Your arms right around me, feeling glad you found me, feeling like I'm home. Wish you would remember April to September, wanting to be near me. Waiting for the sunrise, staring into my eyes, you and I alone. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be lay back on a big screen, you and me together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell Lie back in my own dream, play back on a big screen, you and me together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. The nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish up a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back 'cause I'm gonna be a lonely girl again. Come back 'cause I'm gonna be a lonely girl. up a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I Way back on a big screen, you and me together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish Lie back in my own dream, play back on a big screen, you and me together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. I give up a love found, wish that I could write down what you mean to me. I wish that I could tell you, I wish that I could tell you, I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you, I wish that I could tell you, I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Lying in the long grass, watching as the clouds pass, hands held in silence. Your arms right around me, feeling glad you found me, feeling like I'm home. Wish you would remember April to September, wanting to be near me. Waiting for the sunrise, staring into my eyes, you and I alone. I wish that I could tell you, I wish that I could tell you, I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. The nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Lying in the long grass, watching as the clouds pass, hands held in silence. Your arms right around me, feeling glad you found me, feeling like I'm home. Wish you would remember April to September, wanting to be near me. Waiting for the sunrise, staring into my eyes, you and I alone. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you
That is one. He is with HSBC, and this is what we try to do, bring conversation on this in settled times and decidedly unsettled times as well. I have a minute here to summarize what we've seen this week. It is absolutely extraordinary. And please stay with us through the weekend as we stagger to the Asia morning, 7 p.m. Sunday here in New York. Let me go to the deepest market, foreign exchange. You can see that with DXY dashing up near 114 or 115 print on that major trading index series. That would be extraordinary. Euro doesn't give me any information today. Sterling simply weaker against all that we see to Monday morning. Thank you, Tom McKenzie. Outside Parliament with 110.93. Even dollar Canada looking 138, 139 is extraordinary. Oil not part of the story today. And equity futures, a little bit of a wait to the tape here as we stagger 30 minutes to the open. Please stay with us through the morning. This is Bloomberg.
Starting with you, can you give us a sense of how much the markets are truly in control in the United Kingdom, even as they search for a new prime minister?
Well, the markets have put the parameters, they put the guardrails around this race for the next prime minister, because it is made abundantly clear to the Tory membership, the Tory party, of course, the leading governing party, and everyone here in the UK, frankly, that you need to have sensible financial and fiscal policy, that the markets will punish you if you don't stick to the orthodoxy. Behind me in the Houses of Parliament, you do have that fierce lobbying now behind the scenes, a kind of mercurial atmosphere as the numbers start to add up. So the context is that you are likely to get 3 candidates who will be put their names to a ballot on Monday around 9 a.m. US time. They have to have at least a backing of 100 MPs each. There's 357 members of the Tory party, so that means 3 candidates. Currently, the number coming through, according to the Bloomberg number crunches, is 52 for Rishi Sunak, the former Chancellor of the Exchequer. 52 MPs backing him, so he's more than halfway through. 28 for Boris Johnson, the former Prime Minister as well, and what would be a remarkable turn of events. This is a man, of course, who's cut his holiday short in the Caribbean to fly back to the UK to gauge the opportunity as to whether or not he throws his hat in the ring. And then there's the former Defence Secretary, Penny Mordaunt. She's currently got 16 MPs backing her. So that is the process. You get to Monday, it will get whittled down in that ballot of members of the Conservative Party to 2. It is likely that the follow-up will, the second person within that run-up will probably be pressured by members of the Parliamentary Party to step down. If they don't, it goes to a vote from members of the party outside of Parliament. The deadline is Friday the 28th. That's when, at the very latest, they'll have to have chosen a new Prime Minister. But it could come as soon as Monday. You talked about the markets. Yes, today yields up, the pound down. But broadly, as you mentioned, yields have come off this week. Bonds and gilts have been bid. A crucial timeline for markets and investors is that fiscal plan that the current Chancellor says will be outlined on October the 31st, question marks as to whether or not that deadline will be kept, and that is crucial for markets.
You can manufacture a whole new way of manufacturing. Disrupt buying habits before they disrupt your business, and fuel the search for what comes next. So, what are you waiting for?
Who's the next Prime Minister?
That is the question. At the moment, we see these spreadsheets of Tory MP nominations for each candidate. At the moment, Boris Johnson and Rishi Sunak are the 2 front runners. Heavy caveat there, though. We are pretty sure Rishi Sunak is going to run. We aren't sure yet that Boris Johnson is going to run. He is clearly canvassing his support. He's trying to work out whether there is a path to victory for him, and whether that is at all plausible. That's the key question, really, over the next 48 hours over the weekend, really, before the nominations deadline ends on Monday. Then there's Penny Mordaunt. This is probably the 3rd candidate who does have the realistic chance of getting to that 100, key 100 number that gets you on the ballot.
So, Alex, give me a sense, first of all, Boris Johnson. He needs to get 100 MPs to vote for him. So, do we find out tomorrow who's likely? I mean, what's happening right now? Do the candidates, and no one has said has put really themselves forward, but do they call MPs to try and muster support to look to see if they have the numbers before we have officially their names?
Yes, exactly. So actually no no candidate has declared yet and said, yes, I'm running for Prime Minister. No one wants to sort of jump the gun and be seen as, been plotting in the background over the last few days of this trust. However, behind the scenes at Westminster, those are the conversations that are going on text message, on phone calls, between people like Boris Johnson, Rishi Sunak, people around these candidates, their advisors, their MP supporters, ringing around MPs to try to work out whether they realistically can get to that magic 100 number. If they can't, they may not decide to stand. We've already seen a couple of lower profile candidates, the likes of Grant Shapps, the new Home Secretary. He said that he won't be standing. He was definitely thinking about it. He was having conversations with MPs, and I think it was clear to him that 100 MPs was an unrealistic target for him, and so he's decided not to stand. That's the key question for these candidates right now, and this will all be taking place next 8 hours, 12 hours, 24, 48 hours really, until Monday. It's going to be an absolutely extraordinary weekend of horse trading in Westminster.
I have a bold plan to grow the economy through tax cuts and reform. It was becoming a distraction, so that's why we immediately changed that policy, and that's the kind of government we are. We will keep an iron grip on the nation's finances. Mr. Speaker, I think the last thing we need is a general election. We need to act now to reassure the markets of our fiscal discipline. I have therefore decided to keep the increase in corporation tax that was planned by the previous government. I am a fighter and not a quitter. I recognise, though, given the situation, I cannot deliver the mandate on which I was elected by the Conservative Party. I have therefore spoken to His Majesty the King to notify him that I am resigning as leader of the Conservative Party.
Earn a $258 Singapore welcome bonus when you open an account with ONE. Simply sign up today, deposit a minimum of 4,000 Singapore dollars and meet minimum trade requirements to receive your bonus. Promotion is only available to Singapore residents who have not previously funded or traded in an ONE account.
Was it so wrong? You know you said you loved me.
Entering a stock when it dips is the worst move you can ever make. Keep watching and I'll show you a simpler and better way to reap maximum profits in the market. How many times have we experienced this? You buy a stock, the price goes down. You sell a stock, the price goes up. Instead of buying low, selling high, now it's buy high and sell low, especially when the market now is very volatile. It seems difficult to spot the best time to buy. But what if I tell you there is a ridiculously easy way to know the exact price to enter and exit any stock in just 2 minutes? No guesswork, no complicated technical analysis, no staring at the charts for hours. You can master it immediately, even if you've never opened up a stock charts before. If you want to know how, check out this 3-part video series where I will show you exactly how you can identify profitable entry and exit point for any stocks. In this video series, I condensed all my strategy, analytical trades, and frameworks over the past 17 years of trading experience. And now, for a limited time only, you can get it for free. Click on the link around this video to get your free access and start trading profitably within the next week.
Staring at the top sheet, listening to my heartbeat, wondering how to say it.
We want to just get a sense, though, honestly, it is important to put this into perspective, and Michael Purvis can help us do that. Just briefly, before diving back into the political fray in the United Kingdom, Michael Purvis of Talbot Capital, as you've been parsing through all of the political discussion, how much of a message do you take back to markets, to this idea that they are in charge and they're imposing fiscal discipline?
Well, I think there's a really important overarching theme here that we can divine from this whole trust episode here, which is that, look, the Fed has been on this sort of America First monetary policy that has been, of course, very hawkish as it needs to tamp down inflation here in the U.S. But when you have fiscal experiments overseas that are that trust, the markets is much higher, and you have this collision of bad fiscal policy with what the Fed is doing right now. And I think that's very, very, very important. I mean, I think it's a fair statement that central banks generally like low currency vols here, right? It just makes their job easier. And we're in a state of where, we can talk about rate vol being super high, and of course equity vol's high, but FX vols are super, super high here. And it ultimately makes the central bank, we're all grappling through when central banks are going to be more, sort of not led around the nose by inflation and hydrocarbons, and when they can actually lead as opposed to being reactive. And these types of situations only make central banks, whether it's the BOE or even spill over to the Fed, more reactive.
Michael, that's right where I wanted to go. Neil Shearing to join us later in this hour with a real focus on the United Kingdom economy. But as Mr. Purvis, folks, talks about vol and, of course, his careful study of the Pacific Rim and ADXY, it is thrilling to bring you this morning Nick Benenbrook. He is Wells Fargo international economist, but he viscerally understands the Pacific Rim with his heritage of New Zealand, and far more, is the only person on the planet
胡锦涛被架离而
foreign exchange in back-to-back years. Nick, I guess it's good you're not an FX strategist this morning. Purvis talks about FX vol. Give us the vol we're going to see on British pound sterling.
Well, I think certainly for the next few days we can expect this volatility to continue. It might actually be in the upwards direction because you could argue that political and policy uncertainty is reducing in the United Kingdom, and so we might see a bit more of a relief and go back towards the sort of even up to the 113, 114 level. So I think we're going to see some further up move. Over the months ahead, I think as stuff settles, we'll start to see markets calm down a little, and we might actually start to see the pound, when it's faced with the reality of the UK economy, the pound might start to give back some of those gains.
Mom, I'm not a kid anymore. Don't keep telling me what to do.
Papa, I'm already 14. Can't you let me wear what I want? Daddy, I know I can be moody and irritable sometimes.
I can't spend as much time with you. These changes are part of growing up, Mom.
But some behaviors are signs that I really need help. Like, if I say life has no meaning and I want to disappear.
If I stop doing things I like.
If I suddenly start eating a lot or lose appetite, I'll stop taking care of myself.
If I stop wanting to hang out with my friends.
Not all teenage behavior changes are normal.
Please, reach out.
Even if I push you away, don't give up on me.
I'm counting on you. Papa.
Mom.
Daddy.
Ma.
We need you to spot the early signs.
Don't let me go.
Can the Prime Minister survive this?
No. I'd be very surprised if she can last the week at this point. Just to give you an idea of how much confusion there is over this, both the statements you made just now are currently being denied. The whips now say that they did hand in their verbal resignation, but they're now going to carry on. And Suella Braverman is saying she resigned, she wasn't fired. So the fact that there is this kind of confusion over the person who is running the parliamentary party of Britain's governing party, and the person in charge with maintaining law and order in the UK is quite terrifying.
So how does this play out in British politics then? Because I know the general election is not until 2025.
Late 24, but you can hold one earlier if you want to. Britain doesn't have a written constitution. There's always that much more give in Britain than there is elsewhere. The reason you don't likely have an election much before then is because at this point the Conservatives would lose horribly. Frankly, at this point, I think it is impossible for the Conservatives to win the next election. They just have to hope that the Labour Party loses the next election, which is still just about possible. But what is intriguing, if you take take a look at the UK gilts market, it's actually stabilised quite nicely today. Gilt yields fell fairly significantly, while everybody else's yields, as we've been discussing, went up. 30-year gilt yields are now below 30-year Treasury yields. So from the market point of view, the crisis, I wouldn't want to say it's over, but the acute phase of the crisis is over. And that's basically because politicians are in such a mess that the Bank of England and the Treasury can be, will just be left to get on with it.
John, this government has almost become an object of ridicule now in the United Kingdom.
I wouldn't agree with you almost.
So.
Carry on. Sorry.
I'll just refer to the Sun newspaper, which is running a live feed right now of a head of letters alongside a picture of Liz Truss asking which one's going to last longer. But in realistic sense, what needs to be done here? Because there has to be a rule change to remove Liz Truss, or will she resign? Which of these two things is more likely?
If I were her, because she's still not that old and has a few more decades of life to enjoy, I would try to salvage some dignity and resign. But I'm not her. She obviously has a different way of operating from many of us. I would imagine that it's going to be the easiest way for her to go. But the thing that is tricky is that the Conservatives have to choose a successor, and the current rules mean that if you have more than 2 candidates, you whittle them down to 2 and have to put those 2 to the party in the country, who are in many cases considerably more conservative than the country as a whole. Many of them still feel bitter about the fall of Boris Johnson. So they have the reason, if she does survive another few days, it will be because the Conservatives are trying to work out how they can sort themselves out, how they can change the rules.
All right. Yes, and I was actually incorrect. It's the Sun, it's the Star, not the Sun, that's running that competition. But in the cosmological sense, those two things aren't the same.
We just hired Ken. Ken delivers packages under the blazing sun or in pouring rain. Ken will scale great heights or even over water. Ken delivers to the right address every time.
Where does this leave the Prime Minister? That was the middle of the day. After that, we had a whole series of seemingly chaotic developments surrounding the Home Secretary, surrounding the whips, surrounding voting in the Commons, and allegations of other MPs being sort of manhandled into voting lobbies. Where does this leave the Prime Minister?
Well, she only added to Keir Starmer's list of what was gone from her premiership. She lost 2 of the holders of the great offices of state. She's lost her economic strategy, and now her only connection to her core is Brexit. And yet, because of the replacement of Suella Braverman with Grant Shapps as the Home Secretary, she's now surrounded in her cabinet by Remainers, her political enemies, people who supported Rishi Sunak, the former Chancellor, to be the leader of the party in the summer leadership election. And the party seems to have lost its dignity. You had backbenchers absolutely livid when they were being interviewed in the Commons late last night. So Liz Truss is looking desperate. It seems that she's doomed. And if she goes today, she would be the shortest serving Prime Minister in British history. I'm going to be keeping an eye out for that podium in Downing Street today. And in case we forget, this is just the chaos in Westminster. Outside, in the real world, in the UK, people have got higher mortgages because of, as T.S. Lombard put it, the moron risk premium.
Yeah, that said, gilt yields did continue to drop yesterday, so maybe we're watching markets trying to disconnect from all the chaos in Westminster. And just wanted to mention one of the lines coming through in one of our most recent reports, Lizzie. In a statement sent at 1:30 this morning, the Prime Minister's press secretary said she would be taking disciplinary action against MPs who voted against the government. I sense, just briefly, Lizzie, that the fight isn't quite over. I mean, we can't say more than, I mean, that was 1:30. Who knows how things have developed between then and now?
And yet somehow the Prime Minister herself didn't manage to vote because she was chasing the Chief Whip around, begging her not to resign. Absolute chaos.
The political chaos, where does it leave the Prime Minister?
Well, Tom, there's huge pressure on Liz Truss to quit. Until yesterday, the consensus seemed to have been that they'd at least let her cling on until the Halloween budget. Apart from the weather, it very much feels like that morning when Boris Johnson woke up and realised he needed to write his resignation speech. The question is whether Liz Truss has the self-awareness to do the same, because throughout the day yesterday, she added to Keir Starmer's list of what has gone from her premiership. Gone is yet another holder of one of the great offices of state, Suella Braverman. Gone is her economic strategy, leaving her only connection now to her core vote as Brexit. But in her cabinet, the replacement for Braverman is someone who voted for Remain, who voted for Rishi Sunak to be the leader, and gone as well is the party's dignity. Backbench Tory MPs last night were livid, frankly, because of the chaos that ensued on the vote on fracking last night. There were allegations that an MP was manhandled by two senior ministers, although he and they denied it. So Liz Truss is desperate. It seems that she's doomed, and if she goes today, she would be Britain's shortest-serving Prime Minister.
This is how Anne keeps her home clean and sparkling. Get busy relaxing with Urban Company. Now available on Apple App Store and Google Play.
The Times of London is saying that Boris Johnson is expected to stand in contest at a time when perhaps, where was he, the Caribbean? And people are wondering or trying to find this. But Guy Johnson is with us. Guy, your reaction to this headline?
Maybe he will cut his holiday short. Maybe he will return. It's interesting. So you've got a sort of two-stage process here. And I think we need to think about those two stages as being distinct. So it was interesting to hear what Lizzie had to say about the possibility of one candidate ultimately being put forward. Is there the tolerance within the Conservative Party after the huge volatility we've seen over the last few days for a Boris Johnson return? Is that something, are they prepared to go back to what was a fairly chaotic effort inside 10 Downing Street from Boris Johnson and his team? Or are they looking ahead thinking what we need here is actually stability? And Boris Johnson, as John Micklethwaite was putting out a little bit earlier on, not exactly synonymous with that, Tom.
My amateur take, Guy, is Johnson was thrown out because of scandal, cocktails, whatever it was. I don't remember the details. I don't care. Are the Brits, as Farrell would say, are they forgiving of that to say you were thrown out, you served your punishment, and would we see a different or new Prime Minister Boris Johnson October 29th?
There's been very little evidence of a new Boris Johnson, but I guess anything is possible. Boris Johnson, I suspect, is very popular within the Conservative Party grassroots, i.e. the party, but within the parliamentary party, which ultimately is going to decide which two candidates go forward, I don't know. And that is where the challenge for Boris Johnson is ultimately going to be here. Clearly, he would like to return. Right. Clearly, he is interested in retaking 10 Downing Street. But nevertheless, he has got to convince the parliamentary party that that is a good idea. And I think they threw him out because they were sick and tired of the turbulence. We just had even more turbulence. I'm not sure that they want any more
but Guy,
at this point.
There's also an issue here with the overhang of Brexit, because Boris Johnson oversaw the whole process. How much is Brexit still a popular decision, especially in the wake of the turmoil that we've seen over the past couple of months?
It's still a hugely divisive issue, Lisa, and as we were hearing earlier on, it is not a completed project. And therein lies the problem. Boris Johnson didn't get Brexit done. Do we want to return to the instability also that the issue of Brexit, when pursued aggressively can generate. The Northern Ireland Protocol, we haven't talked much about that, have we? But it still lingers as an issue. It was interesting to hear what Mr. Macron over the channel had to say an hour or so ago.
Yeah.
The issue now is the parliamentary party is in job preservation mode. Is Boris Johnson, is that boosterism, is that cakeism going to be enough to get him back into prime position? I don't know.
巨额奖金美金30钱，预测竞赛，超级足球赛事。敬请关注 Want to Play， 想玩想 Want to Play。
Is this a concern for you, Danny, that there will be the beginning of or an acceleration in the fraying of the Union in the United Kingdom?
Well, it certainly seems so. Obviously, the Scots did not vote to leave. Neither did the Northern Irish. And in fact, what's interesting, if we've been talking about Brexit, the one place that actually has been growing pretty strongly is Northern Ireland, which is more closely linked to the European Union. So certainly I think that, I mean, I've spent a lot of time in Scotland. The Scots don't feel part of this English right-wing story of trickle-down economics. I think the answer is going to be over the next few months. What happens is this libertarian right lurch, has that now gone? Where do we go? I mean, the popularity of Brexit is declining even in England. And obviously, you're right. The First Minister of Wales this week, famously a quiet man, lost his temper with some of the comments that were being made. So I think there's a real issue here. The support for Brexit, I think, seems to be declining. But ultimately, we're going to have to try and get through this chaos. I think that's the first order story. I mean, let's just go back, in a sense, to all of this. All of this came because Truss didn't listen to comments of many people, including me. I said, Truss is going to have to go from Mrs. Stupid to Mrs. Sensible, given what she said as a campaigner. So she didn't do that. So we're in this position of chaos. Maybe this reordering will bring the country together. I doubt it, but it's hard to think, where does this go? I mean, this morning we didn't know where it was going to go.
I came into office at a time of great economic and international instability. Families and businesses were worried about how to pay their bills. Putin's illegal war in Ukraine threatens the security of our whole continent, and our country has been held back for too long by low economic growth. I was elected by the Conservative Party with a mandate to change this. We delivered on energy bills and on cutting national insurance. And we set out a vision for a low-tax, high-growth economy that would take advantage of the freedoms of Brexit. I recognise, though, given the situation, I cannot deliver the mandate on which I was elected by the Conservative Party. I have therefore spoken to His Majesty the King to notify him that I am resigning as leader of the Conservative Party. This morning I met the chairman of the 1922 committee, Sir Graham Brady. We've agreed that there will be a leadership election to be completed within the next week. This will ensure that we remain on a path to deliver our fiscal plans and maintain our country's economic stability and national security. I will remain as Prime Minister until a successor has been chosen. Thank you.
We challenge the investment status quo by challenging each other. Welcome to the power of independent thinking at scale.
Welcome to Wellington.
Wellington Management. Invest in unique perspectives.
Lizzie, what is the latest in terms of who's lined up to succeed Liz Truss? What will happen in the time when she will remain Prime Minister until her successor is named?
Well, Lisa, we know that Liz Truss invited Graham Brady to Downing Street today. It's not clear whether he told her that it was time to go, or whether she felt like stack of letters of no confidence was going to get so high it would be a humiliation, and she's gone. But what we do know is that it's going to be a week-long leadership election, by the end of which we'll have a new Prime Minister. And the names, well, the favourite right now is Rishi Sunak, the former Chancellor, who of course ran against Liz Truss over the summer and was the MP's favourite. But there is, well, of course they are. Boris Johnson's allies are arguing that he's got the biggest mandate because he was actually chosen by the general public in 2019, but whether the public's forgiven him for all the scandals when he was in number 10 is another question. And I would just add, where Guy is saying that, you know, real people they care about their mortgages, they've not just had the chaos of the Truss government, they've also had the chaos of the Johnson government throughout the pandemic and in the months leading up to his downfall. Other names on the list, Penny Mordaunt, she's been pretty much auditioning in the Commons, but Jeremy Hunt, who seems to be in charge here, has ruled himself out.
The only mandate she's ever had is from members opposite. It was a mandate built on fantasy economics, and it ended in disaster. The country's got nothing to show for it except the destruction of the economy and the implosion of the Tory party. I've got the list here. 45p tax cut, gone. Corporation tax cut, gone. 20p tax cut, gone. 2-year energy freeze, gone. Tax-free shopping, gone. Economic credibility, gone. And her supposed best friend, the former Chancellor, he's gone as well. They're all gone. So why is she still here?
Mr. Speaker, I am a fighter and not a quitter.
One of the key things that came out of today related to the pension story here in the UK. We have a triple lock pension system here in the UK. It is indexed to inflation. Inflation is rising very sharply, as we saw today. The new Chancellor, he wouldn't commit to that triple lock continuing, but the Prime Minister, she committed to it. Are they on the same page?
Earn a 258 Singapore dollar welcome bonus when you open an account with Oanda.
I think the UK is the canary in the coal mine for everybody around the world, even for the US, for Janet Yellen, for the Fed. You don't want to do a UK, seems to be the conclusion from talking to foreign policy makers. When it comes to budgetary constraints, don't push it.
You don't want to do a UK. Jordan Rochester there, the G10 FX strategist over at Nomura. Things you never want to have to say, I guess, as a Brit. Futures right now on the S&P, negative 0.75% on the S&P 500. We are lower off the back of weaker than expected earnings after the close yesterday. Yields are lower too on Treasuries, down 3 basis points on a 10-year just north of 4%, close to 4.1%. I say on Treasuries because they're not on gilts. Your 2-year in the UK is up 11 basis points. Your 10-year up about 5. Further out along the curve, 30s, 40s and 50s, a whole lot softer. And at least off the back of a series of headlines this morning suggesting that the UK government will delay the fiscal statement. They are going to delay that fiscal statement. That new date is November 17th.
And what's the implication here? That basically the Bank of England does not have any space to really pull back from a 100 basis point rate hike or something more aggressive in the face of inflation, and that is going to bleed into this whole rate structure higher. It's unclear why they're doing this. As you pointed out rightly, John, why not come out with some framework, some bones, and say, here, this is what it is. You're going to hear more details and an OBR assessment on November 17th.
I think the Chancellor's trying to do that right now. So let's get over to Lizzie Burden at Westminster. Lizzie, the Chancellor speaking just moments ago. Walk us through what he had to say.
Well, he's trying to reassure us after Mohamed El-Erian has said that this delay could reawaken the bond vigilantes. Hunt says that there will be a full forecast from the Office for Budget Responsibility. He's spoken to the BOE Governor Andrew Bailey. The priority is restoring economic stability. Debt will be falling in the medium term. They are willing to make politically embarrassing choices. This is what we've heard so far from the Chancellor, Jeremy Hunt. He's kept his job. Ultimately, he wanted to press ahead with the original Halloween date. But what we've heard behind the scenes is that Rishi Sunak wanted the delay because, of course, this is premiership defining. In answer to your question, why did Sunak want to delay? He used to be the Chancellor, remember. He's going to want to delve right into these books. And as Hunt has put it, these are eye-wateringly difficult decisions that need to be made. Although former BOE and OBR official Charlie Bean has said that he expects the fiscal black hole may have shrunk from £40 billion before to now just 30. Still, they're going to want to look closely at which levers they're pulling.
Lizzie, November 17th feels like a lifetime away. Let's get to November 3rd, first of all. That's when Governor Bailey has to make a decision at the MPC with the Bank of England. Can you walk us through what that decision is going to look like now?
Well, you have to take into account that we're now into double-digit inflation, back where we were in July. But given that we're not in the space of trustonomics, investors had pared back their bets from 100 to 75 basis points. I think you'll probably see that you've still got the hawks on the committee who are worried about this getting out of control, and it wouldn't have taken at the last decision many more to join them, to push them towards a bigger hike. Will they want to front load? Will they have less of a need to do that now, given that we seem to have someone who is desperate to reassure us that they've got their hand on the tiller, that they can calm the markets. That is the ultimate message that Jeremy Hunt is making here, that they will balance the books in the medium term. You have to wonder, will the BOE be reassured by this message from Jeremy Hunt?
Over in the United States, Lizzie, there's starting to become some pushback against the Federal Reserve and how quickly they're raising rates. Is there a similar feeling in the United Kingdom right now? And on the margins, politicians coming out and accusing the Bank of England of moving too quickly given the deteriorating growth prospects. Is that something that's in the zeitgeist?
What a swing of the pendulum that would be. After the whole summer, Andrew Bailey took flack for not acting fast enough on inflation, the BOE even being threatened with mandate review, although that seemed to drop by the wayside as soon as Truss got into office. There may be criticism, of course, because this is hurting ordinary Britons, and one of the big criticisms of Rishi Sunak is that he's so personally wealthy, he can't understand the plight of ordinary Britons in the cost of living crisis, and then to have the Bank of England making it even harder with a massive rate hike. I'm sure that there are many people who don't want that. But you've seen mortgage costs coming down because markets have been reassured by Rishi Sunak taking over. I'm sure that many people have their views on the Bank of England, but at the moment it seems like they are leaning towards 75 basis points.
Is Rishi Sunak starting his reign with popular support that is sufficient? Should there be some sort of general election in 2 years?
Look, he's got a huge mountain to climb here. All the latest polling shows that I think 2/3 of people in a YouGov poll said that they thought he was out of touch. He's really going to have to make an effort to convince people that he's genuinely empathetic to their cause. He said a lot in front of Downing Street yesterday about how he's fixing the mistakes of his two predecessors, and yet if you look at his selection for cabinet, he's reappointed the biggest names of Truss's cabinet, the three great officers of state: Cleverly, Hunt, Braverman, back. And Braverman, of course, the Home Secretary, supported this policy of shipping asylum seekers off to Rwanda. Does that look like the compassion that Rishi Sunak was promising? I'm sure that this is the question that Labour's the opposition leader, Keir Starmer, is going to be asking at Prime Minister's questions today. Braverman there, seemingly, because Sunak's had to do a deal with the Tory right in order to get into office, a complaint that the Deputy Labour leader, Angela Rayner, has been making. So you know, there's hope that this is the new era of boring versus boring and a calmer time, but getting into office is probably the easiest bit for Rishi Sunak.
I think we'd all like it to get boring and quickly in the UK. Lizzie, thank you. Lizzie Burden in Westminster. PMQs in the UK starting in about 35 minutes' time. Lisa, I have to say, in normal times, this is pretty straightforward. You've got a new Prime Minister. He wants to go through things and make sure that the fiscal plan is it, and he's on board with it. So you wait a little while. These aren't normal times. And I think this makes it very complicated for the Bank of England. I don't want to go too far with this, though, because I think there is an opportunity now for the Chancellor and the Prime Minister to really lay out what they plan to do on November 17th. And if those plans don't spook this market too much, maybe you can get back to, dare I say, business as usual.
My issue is, and this is where I'd push back just a little bit, if they pulled another Liz Truss and came out with some sort of plan that did not actually become feasible on some sort of economic level that they had to walk back, that would be so damaging for the United Kingdom yet again. So that's my one pushback that seems like maybe it's in their best interest to wait a little bit longer.
The gilt curve's a bit of a mess, I have to say. It's up 9 basis points at the front end, 10 years not doing much. Then at the long end, on a 30-year, we're up 10 basis points as well. This market's been a bit of a mess over the last month. From New York, this is Bloomberg.
You can buy a slice of pizza. Why not trade a fraction of a stock? Investing in companies using fractional shares on Interactive Brokers is as easy as pie.
No, I didn't buy anything. How's the food? We're still preparing the food.
I heard the food is almost ready. Get free 2-hour same-day delivery for eligible orders over $60 on Amazon Fresh with Prime, your one-stop grocery shop with great prices on everyday essentials. Shop now on Amazon.sg and host a house party at your convenience. Use promo code Joanne5 for $5 off on your next Amazon Fresh purchase. Terms and conditions apply. Spend less, smile more.
Three days of big gains on the S&P 500 colliding with negative news after the close yesterday. Let's get straight to it. Futures right now on the S&P down 0.7%. Guidance from Microsoft weak. Numbers from Google not great. Meta coming up after the close. The Nasdaq 100 futures down 1.6%. A rally in the Treasury market. The house price growth data yesterday in the United States not great at all. Yields lower, much lower, and lower again this morning by 3 or 4 basis points on a 10-year to just north of 4% on a 2-year, down 3 basis points at 4.44. Bear in mind, we had a look at 460 in Friday's session on a 2-year. We've backed away from those levels in a big way in the last couple of days, including in the session on Friday as well. Want to finish on foreign exchange. What you do see right the way through G10 this morning is a much, much weaker dollar. And even with the concerns in the UK, that pound strength, it sticks. 115.60 and a higher session, Bramo. 116.20 on cable. At the end of September, 103.50. So we've gone from 103.50, which is a generational low in a currency, and now we're back at 115.60.
And some people might say this is very much a Britain story. There is leadership, and Rishi Sunak is thought to be coming out with a more conservative plan of austerity. This also could be very much a dollar story. I mean, there are reports that China is selling its dollar holdings in order to support the UN, that we see that kind of intervention coming from over in Japan. How much is that also a big piece of what's going on more broadly?
This is what the rest of the world wants to see, right?
Yeah.
The Japanese, the Chinese, the Europeans. You'd imagine this is what they want to see.
Well, I mean, this makes it easier for them to not import inflation to such a big degree. At the same time, how sustainable is it if it's just a matter of selling dollars or selling FX reserves and there is no structural change in either the economic outlook or some of the monetary policies of the likes of Croda?
If you'd like the update on the United Kingdom, the sequencing before today looked a little something like this. At the end of October, you were set to get a fiscal statement from the Chancellor and the British government. And then on November 3rd, you would have a Bank of England rate decision. And ultimately, the BOE, the MPC, would be able to sit around a table, they'd have the fiscal plan, and they could make a monetary policy decision. What we understand from this morning is that plan will be delayed. That statement from the fiscal side of things, from the UK government, will now come on November 17th. So when the MPC gets around a table, Lisa, they won't have those plans. I guess they'll have a decent idea of the direction of travel from the British government, because we'll hear from Rishi Sunak, the Prime Minister, in about 30 minutes' time.
Okay, but you raise this, and I think it's a really important point. The market moves now. They're not going to wait until November 17th to move. So how much are they going to adjust their plan depending on where the market is? And if they do see some sort of big move, do they pull that up? Right? I mean, this is the issue when you have a vigilante market. How much do they pressure a Rishi Sunak that's trying to be deliberate and methodical? I'm playing both sides here because I'm not sure the right answer, but it shows a real tricky bind right now that the UK is in.
I'd say relative to the moves we've seen in the bond market, specifically the gilt market over the last month, a move of 7-8 basis points to the front end is not a major move. I mean, we were talking about 50 basis point moves several weeks ago.
Absolutely, I would agree. But what happens if the Bank of England says, okay, we've got to go 100 basis points. We have no idea what they're going to do. We're very concerned about what's going on with inflation. Does that change the equation for then what comes out on November 17th? Do they start to feel pressure? I'm just, right now, you're right. The moves aren't that major because Rishi Sunak seems to be the controlling kind of, status quo and bringing things back on the rails. How long can that last?
For now, at least, Sunak and Hunt seem to have the credibility that Kwarteng and Truss did not have. To your point.
Well said.
How long does that stick? I guess we get the first test in PMQs in about 27 minutes' time, and then we'll get the reaction from Lizzie Burden over in Westminster too. Joining us now is Asa Linios, the Global Head of FX Strategy at RBC. Asa, I'd love your reaction to what we're hearing from the British government and ultimately what it means for pound sterling, with cable seeing a higher session of 116.20 this morning.
Sure. So I think, as you said, a lot of this is dollar weakness rather than sterling strength. But on the UK side, some interesting developments, because I think Sunak and Hunt probably right to actually delay that statement, certainly from October 31st. I mean, the tabloid writers would have had a field day with the Halloween headlines. And yes, it makes the Bank of England's decision a lot harder on November 3rd. But I think what Sunak and Hunt are hoping is that if the current momentum continues, you can see global bond yields actually coming down everywhere, that the hole they have to fill on November 17th will actually be smaller rather than larger.
I have no idea, Lisa, why it was ever October 31st. As soon as I saw the headline, it's exactly what I said. Why are they doing this on Halloween?
Oh, my gosh. I almost feel like I kind of want it to be October 31st so that we can see those tabloid headlines. I mean, is that really a reason to delay it?
A lot of people talked about the incompetence of the former leader. I always had a problem with that October 31
I think it's great.
timing. I thought it was ridiculous. So we do have a meeting of the MPC, of the Bank of England. A decision will come on November 3rd. Does this complicate things for them, and to what degree?
I mean, I think for this meeting, probably 75 and then a wait and see. Further out the curve, there's quite a lot in the price. And actually, we're looking for, say, June 23 Sonia's to rally a little bit. But they don't need to make those decisions right now. And they certainly don't need to give any forward guidance. They'll be very much guided by what comes out on November 17th and the state of the market as they make each and every decision. So, yes, they're not in an easy position, but I think their position is a lot easier now than it was a few weeks ago.
Elsa, as you said, this is also very much a dollar weakness story. How sustainable is that dollar weakness?
And that's a critical question, Lisa. I mean, we had on Friday that apparent shift in rhetoric from the Fed right before the blackout. Then over the weekend, developments in China made markets a little bit risk averse on Monday. Now it appears to be turning again. We've seen euro-dollar break some pretty big levels, not just parity, but the downtrend that really started in January. And so if we see a combination of lower yields, slightly higher equities, I think the dollar will be in a little bit of trouble for the next month ahead. Longer term, structurally, like you said, it doesn't change anything fundamentally. But for now, I do think there's a little bit of profit taking and a relief rally for other currencies.
John, Elsa was just saying on Friday we got hints of something different from the Federal Reserve. Is she talking about a particular article in the Wall Street Journal? Is that really what people are hinging this all on?
I don't think you need to read the article in the Wall Street Journal. I think Mary Daly said it for herself over at the San Francisco Fed. I think other Fed presidents have said the same thing. This whole idea about a step down, though, can you have a step down without the CPI confirming a deceleration in inflation in a much bigger way? Now, we can all identify falling prices, and I've heard the pushback, and I'm sure I'm going to get it any minute now on my Bloomberg terminal. Those messages will light up. I get all of that. It's not about what I think the Fed should do. It's what they're going to tell us they will do. And what they're telling us they will do is that they need a convincing, several months maybe worth of core data that tells them that they're on a trajectory back towards a 2% inflation target.
Well, and there's this other question of, let's say the Fed does have a step down, right? And then they keep rates at 4.5% for a prolonged period of time.
Sure.
Elsa, is that going to mean that the dollar is going to be weaker? Or does that mean that it will be stronger because it will be a more persistent, higher yield, and it means that the rest of the world isn't catching up necessarily at the same pace?
Right, and that's what I wanted to come on to with, the structural comment, because to your point, Lisa, if they are going to keep rates at 4.5%, and yes, other central banks are hiking, but they're also beginning to slow down, the dollar is going to maintain that yield advantage, and it's going to maintain effectively the status of the highest carry, or one of the highest carry currencies within G10, and even relative to several emerging markets. So, I think you've got to distinguish the kind of short-term tactical repositioning from the longer-term structural moves. And at the moment, we've not yet seen that turnaround in US inflation that will really get the Fed to actually cut rates rather than just pause the hikes.
So bear with me, this isn't exactly a butterfly theory, but how much is the UK getting a reprieve from what Japan and China are doing to try to support their currencies?
I mean, it's often been said that politics is all about timing, and you can't exactly feel sorry for Liz Truss, but you can look at kind of global developments and feel like had she not had such terrible timing, she perhaps might have lasted longer than that letters. I mean, all I'll say is that, yes, there is a bit of a reprieve here for the UK, but certainly they have their work cut out as well. It's not going to be straightforward sailing, especially with the current account as it is at the moment.
Do you remember when everyone got really excited about a step down in rate hikes earlier this month? And it was because the RBA over in Australia didn't go 50, they went 25. Well, we had CPI data out of Australia overnight for the third quarter, and it surprised big time to the upside. So I know this is a lagging indicator of things, and I'm sure the RBA has got a lot of tightening in the pipeline, but is that a warning shot to this Federal Reserve?
In part, but I think also what will be interesting is to see how the Bank of Canada reacts today. If you recall, the Bank of Canada hiked in March, just a couple of weeks ahead of the Fed, and at the time they were very much seen as, leading things. The RBA was still very much stuck in its forward guidance. So let's see what the Bank of Canada do today. A very finely balanced decision between 75 and 50. I think a lot of people will be looking at that as a sign perhaps of things to come.
Asa, wonderful to hear from you, as always. Asa Limnos there of RBC. Thank you very much on the situation with the Fed and beyond, including the UK. The headlines from the Chancellor in the last 50 minutes or so. We're willing to make politically embarrassing choices. Many changes affect our forecast, even in the last 24 hours. The accuracy in the forecast is, quote, very important. On the sequencing, and I think the sequencing is problematic for many of you, I'm sure, would have made much more sense to have the fiscal plan than the monetary policy decision. We're not going to get that. The Chancellor said he discussed the new timetable, Lisa, with the Bank of England governor. So he's had that conversation with Governor Bailey, and it's over to you, Governor Bailey, now. Next week, November 3rd.
So how does he handle this, right? Especially given that inflation is still considerable and that there is going to be some sort of likelihood of an austerity kind of plan. Do they raise by 100 basis points and kind of come out with shock and awe? I keep going back to the fact that Bank of England is underwhelmed with respect to rate hikes again
Without
and
a
again.
doubt.
So how much do they need to regain a sense of credibility on that side to say, look, we see that inflation is the foremost problem. We're not going to get involved in political games. This is our view.
I'd love to know what they're going to do with QT and for how long. I keep bringing this up, and I think
fair.
we can do it again. The ECB had to come up with its own little mechanism, which hasn't been activated yet,
TPT?
to deal with spreads. TPI, the Transmission Protection Instrument, whatever that is. The BOJ's had to intervene in the FX market. The Bank of England's had to intervene in the gilt market. And the Federal Reserve's doing QT. Thus, many, many people, do you think QT is going to make it to 2023? We've had the financial stability concerns in the likes of the UK. We've had them in Europe before they even got going. We've had Japan had to step back in. The reason I ask this is because we caught up with Mohamed Al-Erin yesterday, and he said if this Fed backs away, it's going to be for financial stability reasons, and that's not great. And if they have to do it because of financial stability reasons, he thinks they get stuck in a quagmire of stagflation. That's a big, big problem. And my issue I have with a lot of people at the moment is they come on the programme and they say the pivot, the pause, the step down, it's really, really, really bullish. OK, it might be in the short term, but it's not if it's for the wrong reasons. And that's what I think Mohamed Al-Erin and others are trying to say.
And this is what we heard from Jean Beauvais yesterday, right?
Sure.
He was saying it's not clear, and 10-year treasuries aren't necessarily a screaming buy here because of just that fear, which is very much on people's minds.
Futures on the S&P right now down 0.7%. More tech earnings still to come. We'll catch up with Ashok Bhatia, the Deputy CIO of Fixed Income over at Neuberger Berman. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. New British Prime Minister Rishi Sunak has delayed an economic plan that was due to be delivered on Monday. It will now be released on November 17th. According to Sunak's office, he wants more time to make the, quote, right decisions on managing the British economy.
Our number one priority is economic stability and restoring confidence that the United Kingdom is a country that pays its way.
The government wants to close a fiscal gap that could be as much as $46 billion. Europe is running out of time to act on natural gas before winter. The bloc still can't agree on what a price cap should mean. Policymakers have gotten a break. There's a surplus of gas in Europe, thanks in part to warm weather, but that's caused a sense of urgency to fade. New York's still the most expensive rental market in the U.S., but Boston has now passed San Francisco for second place on the list. According to rental listing company Zumper, the median one-bedroom rent in New York now $3,860. Boston rose almost 6% this month to $3,060, while San Francisco is $40 less. Google parent Alphabet appears to be preparing for tough times as the economy slows. The company reported earnings and revenue that missed expectations. Advertising sales also were less than expected. Later, Alphabet said it would slow hiring and control expenses. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The risk of a U.S. recession is uncomfortably high. I don't like it where it is. I don't think it's a done deal. I don't think it's 100%. The labor market is still strong, but it requires a Fed that has a lot more skill and a lot more luck because it no longer has time.
The brilliant Mohammed Al-Arian, Bloomberg opinion columnist and president of Queen's College, Cambridge. If you're just tuning in, futures recovering a little bit on the equity market. The S&P 500 down by 0.6%. The underperformance, of course, on the Nasdaq, where the big weightings are taken by big tech, and big tech disappointed after the close yesterday. We'll get to that in just a moment. Yields are lower by 4 basis points on a 10-year, just north of 4%. The dollar is a whole lot weaker. Euro dollar with a 1 in front of it for the first time in a long time. Above parity, euro dollar positive about 5 or 0.6%. Lisa, going into the ECB tomorrow, and I said this a few times this week, I never thought we'd see a week where the PMIs were in the 40s and we'd see the ECB, never mind hiking, but hiking 75 basis points.
And how far away are we from politicians pushing back in a much more meaningful way? You got hints of that in the U.S. You also got hints of that from the Italian prime minister. How much are they going to start pushing back and saying, guys, maybe you don't need to do this. It's not the right
yesterday
Okay, fair.
that the Senate Banking Committee Chair, Sherrod Brown, has written a letter to Chairman Powell that said we must avoid having our short-term advances and strong labour market overwhelmed by the consequences of aggressive monetary actions to decrease inflation, especially when the Fed's actions do not address its main drivers. Chairman Powell in Jackson Hole talked about pain. I keep going back to that speech in Jackson Hole at the end of August. He talked about the amount of pain we'd have to go through because the greater pain was not dealing with it. Well, we're about to see some of that pain and potentially in the labour market, and the political pushback you're going to get is starting to build down in Washington.
But it's on the margins, right? Yes, we've heard that from Sherrod Brown. But how much is this becoming the mainstream, the sort of drumbeat? Is this just basically ahead of the midterms to try to shift the blame? Or is this something that's sincere, where people think that the Fed is actually going too fast in a time when inflation is the highest that we've seen in 40 years? I'm not sure about that yet.
I think if it's a politician, it's definitely politics. But I imagine it's also a bit of both. That concern that Sherrod Brown has is a concern that many economists on this programme have. We need to talk about tech next. After the close, we get Facebook. We've had the ad spend disappoint over at Snap. It's disappointed over at Google. We get Twitter potentially in the next hour or so. Mandeep Singh joins us right now, senior technology analyst for Bloomberg Intelligence. Mandeep, what are you learning about ad spend at some of these big tech companies?
Yeah, I think Alphabet results show that not everything was priced in. You know, we talk about negative revisions and how we've seen, Snap top line being revised 30% for next year. In the case of Alphabet, the estimates have come down by 10%, but guess what? They came out with a disappointing print, and the guidance doesn't seem to be very optimistic. So right now you have a combination of slowing top line growth, and the part that was the most disappointing was on the margin side. Their cost structure continues to go out of control. They talked about lowering headcount for the next quarter by 50%, but still, it's just, the fixed costs continue to rise, and that is what is showing up in Alphabet's margins, which were down almost 300 basis points below consensus expectations.
Let's pause. We've heard a lot of tech layoffs talk, and there's questions about how much more they have to go. Mandeep, are you saying that there need to be very deep cuts to Google's staff in order to become more efficient the way that stock investors would like to see?
I think it's more about why are they growing headcount by 25% when they could see that the top line was decelerating. And granted, there was some pull forward last year. I mean, in the same quarter, we saw above trend growth when it comes to digital transformation and just IT spending overall. So you're going to see a pause. But in terms of secular growth in cloud, nothing is changing. We still think as cloud will grow, high teens. And it's a pretty large addressable market at this point of time, 400 billion plus. So I think in the case of Microsoft, especially on the cloud side, that will be more like a quarter or two growth normalization more than anything else. But ad spend, you really have to think about, is search saturated? And granted, YouTube is going to grow, at a healthy 25-30% clip once we come out of this downturn. But the real concern is around the search cash cow and, how much room does Google have to grow over there?
Google, Alphabet, I hate calling it Alphabet, down hard in the pre-market. We're down about 5 or 6 percentage points. Microsoft, a similar move lower. A little bit later, Mandeep, we get Meta. I hate calling it Meta too. I just can't get used to this. Facebook. Mandeep, we get Facebook after the close a little bit later. We've talked a lot about how they have different clients, different customers when it comes to ad spend. Mandeep, the price of the story, it's been battered this year. You know that well. What are you expecting for Facebook a little bit later?
More pain, more estimate cuts post earnings. And look, I think in the case of Facebook, you're going to see ad pricing compression. I mean, clearly they are the worst hit when it comes to the Apple's privacy changes. And the fact that they're not diversified, in the case of Alphabet, at least you've got, top line diversification, although it's dilutive to margins. In the case of Facebook, this is 98%, advertising revenue. And people are complaining about, their Oculus Reality Lab spend, how it's a big drag on free cash flow. All these companies have to think about capital return. Even Alphabet didn't mention a word about capital returns, buybacks, and, thinking about why would a shareholder be in these companies if they're not, getting that return, because the share count isn't going down and the margins are going down, free cash flow margins are going down. So I think that is the answer that Facebook has to think about, but clearly there will be a lot of top line pressure in the print.
It's a different world. Mandeep, let's catch up tomorrow. After we've all had a little look at Facebook after the close a little bit later, Meta is down by about 4%. Google is down by 5.9% in early trading. And Lisa, I think what was interesting about the earnings yesterday is just the broad sweep of things. It was IT budgets, it was digital spend, it was machinery, industry, autos, the concerns all over the place after the close yesterday.
Everybody's saying that there's a lot of differentiation within the tech complex. Kind of got a dose of cold water on that, because all the differentiation is being beaten up in different ways. How much is this going to lead to further job cuts in the tech world? And that's really going to be the theme, I think, throughout all of these earnings.
Those tech names dragging down the S&P 500. We're down by about 0.7% on the S&P. There is a rally in the Treasury market. Treasury yields are lower on a 10-year in America by 4 basis points. And this dollar is a whole lot weaker from New York City.
What can you do with 60 seconds? At Vulture, you can deploy a cloud server.
Erin, we've just seen the Bank of Canada go 50 bips when the market was expecting 75. How do you think the US equity market reacts when we get to that point for the Fed, where it stops going 75 and starts going 50?
I do think that pivot, if that's what you want to call it, will be, a positive catalyst for markets. But, the Fed is going to be moving down to 50 basis points at a point when they start to see, more significant economic weakness on the horizon. And so, it's a little bit of a careful balance, because while the Fed is slowing, they're certainly not pausing, and they're nowhere close to cutting rates. And so I still think that the equities will trade down. You may get a little bit of a relief rally on the news, but I don't think it's going to be an all-clear signal for equities.
So, Erin, on that, if we get a relief rally, what do you do with it?
I I would fade the relief rally. Right now, over the last week or so, we've been resetting shorts or underweights at, sort of higher levels, taking that as an opportunity to get more underweight stocks. I don't think yet that we've received that all clear signal. So I think you back the rally, but look to reset shorts at higher levels.
You've talked about the risk of a flip-flopping Fed, the 1970s. Remember that column from earlier this summer. Bill Dudley wrote a column for Bloomberg earlier this week, Mohammed, and he talked about whether this Fed was the Volcker Fed or the Fed of Burns. The latter not being much of a compliment, if you believe this is what Chairman Powell is right now. Any similarities to Burns or Volcker at this point, Mohammed? You've read that piece. How did you react to it?
It's a good piece. Bill produces really good, thoughtful pieces that should be read. Look, it's clear what Chair Powell wants. He wants to be associated with Volcker. He wants the credibility, to borrow the credibility of Volcker, and he has cited Volcker in virtually every public statement since Jackson Hole. So it's very clear how he wants to be seen, and for good reason. If you can borrow that credibility, you don't need to be as aggressive on rates. The problem that he has that Volcker did not have is a trilemma. Volcker dealt with growth and inflation. Chair Powell has on top of that financial stability. If they pivot, it will be because of financial stability. It's not going to be because they've decided to not look at inflation anymore. It will be because of financial stability. And the risk here is that we get a quagmire of stagflation as we try and lower the financial stability risk. Again, John, that is what happens when you're late. You have fewer degrees of freedom.
Is there a dollar shortage now, and is that the catalyst for central banks to blink?
It's going to be one of the catalysts. There is a dollar shortage, and the rise in interest rates in the United States is particularly dramatic for EM. They have a terms of trade shock, those that are importing commodities. They have a rise in interest rates because of what the Fed does and their own domestic inflation, and then the weakening of the currency that increases the real value in local currency of their own debt. So for them, it is a perfect storm. Some of them have a lot of reserves. Some of them don't have reserves. Some of them receive IMF money. But there is right now a strengthening of the dollar that is implying even further tightening of financial conditions in the rest of the world. Now, I think that eventually the dollar is going to have to fall very sharply because we have a twin fiscal and current account deficits. In other advanced economies, you have a fiscal deficit, but you have a current account surplus. And now we're essentially using the dollar as a tool of national security and foreign policy. We're weaponizing it, rightly so. Sanctions against Russia, against Iran, North Korea, China. We're starting, by the way, a tech war with China, economic war.
What will be the catalyst for dollar weakness? How do we get there? Forget about this Plaza Clark. It's going
to be essentially the Fed wimping out. Once you see a severe recession.
What does wimping out mean? That means blinking, right?
Yeah, blinking. They're going to blink and wimp out because you'll have a severe recession.
Wimp out. That's a new
financial
term. It's a new step down. It's a mega threat. Yeah. Wimp out.
Well, either you're a hawk or you're a wimp, and so, or a dove in this case. But that's going to happen. And once the Fed is going to essentially prevent an economic and financial crisis, or try to prevent it by essentially stop raising rates, even inflation is too high, then the dollar is going to start sharply weaken. That's going to be the trigger for it. Because what's raising the dollar is, of course, the tight monetary policy.
Duda 初ハイクラス転職サービス Duda X 始まる。
What's your reaction to this at a time when people are looking to the Fed for leadership?
It's inexcusable, and to me, it's not an optics problem, it's an ethics problem. Jim Bullard is one of the Fed officials that is making decisions about rate hikes that have effects in the United States, will have effects for U.S. workers, and they are having effects around the globe. The idea that he gave any kind of private remarks to investors is outrageous, and he should go.
It seems like every time we get together, there's something
in the background. There's something big going on. And I would say this time is the fact that the latest inflation data have been disappointing. You've done 300 basis points of rate hikes since March. The core CPI is basically stalled out. The headline CPI is stalling out just over 8% year over year. Core number continuing to rise. And the employment market, the market's still tight in terms of jobs and the economy not slowing down. So what's gone wrong? All those rate hikes, what have they done?
Well, I do think they will have an impact and in some ways have had an impact. I would cite the housing market in particular, where it appears that increase in rates has really changed the dynamics there. So that's someplace that I would say there are not long and variable lags. That market anticipated Fed moves that before they were even in train this spring. And so that's a place where we've seen impact right away. But, it's a big ship, and it takes a while to steer the ship. And so the housing market is not the whole economy. So
it certainly isn't. And it's certainly not one of the main things driving inflation now. Of course, prices have fallen. But
rents are important, though.
Well, they certainly are.
Yeah.
They certainly are. And in fact, that's one reason why people are so worried about inflation staying high next year, is that those rents are, the way they are calculated.
So that's good news if you're trying to get inflation down. But we'll have to follow through on that in the subsequent meetings this year and get the policy rate up to a level where we can put meaningful downward pressure on inflation. I think that's the main goal immediately ahead of us at the committee.
So, off the cuff right now, what do you say that level looks like it's going to be? Is it going to be higher, for example, than you thought it might be? Is that the risk here? Not that you're going to be okay or you're going to move it lower, but they're actually going to need to have more rates to get to a more restrictive level.
Yeah, I've done this calculation about sort of a minimal level that you would have to get to put downward pressure on inflation. I did it at a conference in Stanford in May, and you can look it up on my webpage. But at that time, the number came out to 3.5%. But since then, the inflation news, unfortunately, has continued to surprise to the upside. So if you do that again now, you're going to get something closer to what's in the dot plot, 4.5, 4.75, something like that. And I think also, we're data dependent and we're watching the data. I think we're predicting, or at least the dot plot is predicting, that inflation will come down. It will be a disinflationary year in 2023. But, there's also a risk that the data doesn't cooperate the way we expect it to, and in that case, we'd have to react.
There's an old axiom in monetary policy that, especially when you have inflation like this, that's very high, that hasn't cooled off, that to get it under control, you have to get the funds rate above the rate of inflation. You're pretty far from there now. Another reason to think that maybe, the tilt of risks here is that you're going to have to do more. Some people are talking about 5% and have been for a while.
If we get driven to that, it'll be because of the data. I mean, the markets are expecting inflation to fall. We've been expecting inflation to fall. I've been expecting inflation to fall, and it hasn't so far. But I think in the first half of 2023, that's still the expectation. And so you will get to some point where inflation has come down some, and you might get to this situation where the policy rate's above the inflation rate.
So why do you still expect that? I mean, if I can push a little harder, because you've been expecting it, markets have been expecting it, and so far that expectation has been wrong. Why do you still expect that?
Well, I think we're taking forthright action to try to get inflation under control. I think there are some temporary factors. I think they were probably overemphasized earlier in this process, but some of these factors, like the war in Ukraine and the supply chain disruptions from the pandemic, certainly do look like they should abate, and some of them have been abating, and we'll probably get more of that going forward. So the thinking has been that those types of things are probably not the types of things that you'd want monetary policy to be reacting to because they're too volatile. But the underlying inflation has been relatively high. We cited already the core PC and Dallas Fed trim mean numbers, which are pretty high, and that's the part that you probably have to act more directly on for monetary policy. But there you're talking about the high 4% range.
So is one of the reasons that you are still, betting on this inflation coming down and not having to move the rate a lot more restrictive is because you're going to stay aggressive with rate hikes right now. 75 basis points in November and then another 75 in December. I know you don't like to prejudge meetings. However, if you look at how the factors are stacking up, is that a likely outcome in terms of what you're going to vote for?
Yeah, I mean, the November meeting has been more or less priced in the markets at the 75 basis point number. Again, I think you do want to wait till you actually get to the meeting, see what the situation is there. The December meeting is a little farther away. We will have more data at that point. I don't want to prejudge exactly, what I'd support at that meeting. And then in 2023, I think we'll be closer to the point where we can run what I would call ordinary monetary policy, or a monetary policy where now you're at the right level of the policy rate, you're putting downward pressure on inflation, but you can adjust as the data come in 2023. And so I think up to now we've been, we started off at a very low level. That's why we've moved so fast, so far, so quickly. But at some point we'll get to a level that the committee judges will be sufficient to put meaningful downward pressure on inflation. Then we'll be able to adjust from there. Not that there wouldn't be further adjustments, but they would be dated. They would be more based on the data coming in, as opposed to us trying to get off zero and up to some level that's reasonable.
Well, let's apply data dependency to the December meeting then. That's only a few weeks away. Inflation is still high, and in fact, when you looked at the core numbers, it looked like some key sectors, medical care, shelter costs, looked like they could be becoming more entrenched. So again, against that backdrop, wouldn't a 75 basis point hike and a little more aggressiveness going into that 2023 drop in inflation you hope to create, wouldn't that be the right thing to do?
Yeah, if you look at the SEP, it does, the median dots do call for further moves in 2023. So if you take that as the committee sentiment, there could be a decision to move that into 2022 at the December meeting, so you could do that. But again, why prejudge that meeting? And how much difference would it make from a macro perspective, I think, would be a good question as well. Whether you put the 25 basis points there or you put it in the first quarter. Well,
what about expectations? What about markets? What about showing people that you've noticed that inflation is still pretty high and you intend to do something about it?
Oh yeah, we definitely do, and we definitely have moved very quickly here. But this would be more a tactical issue on the larger strategy.
And speaking of 2023, and hoping that inflation is going to get to the point where you want it, would that be a point where you would say, yes, it's time to pause?
I think there's a possibility of a good dynamic in 2023, so let's cross our fingers that we get it. But I think if inflation does start to decline meaningfully, we can stay where we are at this higher level of the policy rate that meets the committee's criteria. And at that point, we could watch inflation fall and get back to 2%. That would be a very good dynamic, I think.
Calibration. That's another Fed word now that showed up in the minutes of the September 21st meeting. And people assume, because you've already been going pretty fast, the calibration would mean slowing down. Is that a correct interpretation of this calibration of rate hikes going ahead?
Yeah, I mean, you do have to think about what the reasonable level is. I think these 75 basis point moves have been because we started at such a low level, so we're way below any kind of concept of a long-run neutral. So step one is to at least get up to the long-run neutral, then get above that, then get to some meaningfully restrictive level that would be appropriate for the level of inflation in the economy. But it doesn't mean that you go up forever. The committee is going to reach a judgment at some point about how much is the right amount, and that's what I want to get this idea across of transitioning to sort of what I would call ordinary monetary policy, and you might too, looks more like the 1990s or something like that. So no, you're not at zero rates anymore. You're at some higher level of rates, but from that higher level, you're adjusting to various things that are happening in the economy, including on the inflation front. Does it mean you couldn't go higher? No, you could go higher depending on the inflation developments, or you could stay there and watch inflation fall. Those would both be possibilities. But it wouldn't, you'd be out of this kind of very rapid rise in rates.
Is that something that's important for people, and particularly people in the markets, to realize that pausing or slowing down the pace of hikes does not mean that they end? It doesn't mean that you declare victory on inflation. You just decide that you've tamed it enough that it doesn't need such aggressive moves.
Yeah, I think if you're, what I mean anyway by putting meaningful downward pressure on inflation would mean that you're at a level of the policy rate where you're confident that, okay, I think we're doing we have the right policy, we're doing the right thing, and even if inflation blips around a little bit, maybe in the wrong direction in one report or something, you still feel confident that I've got the right policy even for that situation.
So then are you in that camp, though, that thinks that going slower would be better now because there is a risk of financial instability? We have seen these aggressive rate hikes reverberating not just in the U.S. economy, the U.S. mortgage market, but in other economies around the world.
Yeah, I think step one is to get to the right level, then from there to become data dependent. So, I don't know exactly the argument for approaching the right level slowly. I think on the question of financial stability, I've been citing the St. Louis Fed's Financial Stress Index. That index was at a high level in 2008, was again at a high level in the pandemic, but now is at a very low level. So it doesn't look like there's a lot of financial stress. We'll keep our eye on this, but for now, it doesn't appear that there's a lot of what you would call financial stress in the U.S. economy.
If there were, would it be a possibly that the balance sheet runoff could become a tool in the sense you would say, well, maybe we'd slow it down. Maybe we'd stop removing liquidity, because that's been one of the things that, a couple weeks ago was quite an issue in the bond market, that it seemed like, it's illiquid. We're not able to get what we want here. Would that be, again, if you're not worried about it now, if it does become a worry, is that something that you could do?
Yeah, I mean, we certainly keep an eye on liquidity conditions in the Treasury market and other important markets, but I think when people are talking about financial conditions, they're looking at financial conditions indexes that put a lot of weight on equity pricing. And it's not so clear to me that you just want to have that be your metric, because what if the equity prices were, exceptionally high in the past and now they've come down, or more speculative bets in that particular market have cooled off because of the higher interest rates. It's not clear to me you want to call that tighter financial conditions. If you're concerned about the level of wealth to disposable income, that's actually still quite high for the U.S. economy. So it's not really a wealth effect as you would traditionally think about it. So I think there's some mixing here of the idea of financial stress, which I think is not high according to our index right now, as opposed to financial conditions. And if you have a financial conditions index that's just going to cite the fact that equity markets are down 20-something% this year, well, then you're going to say, well, basically the Fed would be reacting to the equity market. But I don't think we should be doing that because it's too volatile and it's often has excesses in pricing.
Well, this question about how high rates are going to have to go, how restrictive it's going to get to be, is not just about inflation, it's about the economy, because the economy is so resilient. It still seems so strong. We had a story today on Bloomberg which got a lot of attention about the little phrase in the minutes from the September 21st meeting, where the board staff economists revised down significantly their estimate of U.S. potential output. The idea being, the economy is running even hotter than we thought. What does that mean in terms of eyeing policy, and again, how restrictive, where you're going to go next?
Yeah, as you know, I've had a regime-based approach to potential growth, and for now, I think we're still in the low productivity growth regime, so we're still in this rather slow overall pace of productivity growth. Demographics are obviously not going so well for the U.S. as they would have earlier in the post-war era. And other factors, I think, continue to suggest that the underlying growth rate for the U.S. economy is probably in the low state. But I haven't revised that. I was always at this lower number anyway, so I haven't revised that based on the most recent data. I would say this also: the productivity numbers for the first half of the year are extraordinarily negative. And the U.S. economy added 3.2 million jobs in the first half of the year. So what were these firms doing? They were adding all these workers and getting less output. I think that's a tough story to tell. I think that'll get revised. I think the GDP number will get revised out for the first half, but probably not until some benchmark revision too far in the future to be useful for monetary policy. But it doesn't ring true that you would have that many jobs added and that many firms making those decisions if they're really getting less output by adding those workers. There's some stories you can tell that maybe productivity is not growing as fast, but to have a big negative number there is kind of questionable.
And I just want to let our radio audience know, in case they don't recognize the voice of Jim Bullard, President of the St. Louis Fed, that I'm here, Kathleen Hayes, in St. Louis at the bank, talking to him at length. And in terms of that GDP upgrade, how big do you expect it to be? Is it another thing that's going to change people's view and say, wow, the economy is even slowing less than we thought?
Yeah, I think the first half of the year, according to the numbers we have today, it was a negative first half. I think probably a zero first half is probably a better guess. We'll see. And these are revisions far in the future, so you won't be able to check whether I got it right or not. And I think, third quarter growth looks like it'll be positive, so far so good. I also think that on the labor market side, we've continued to see a very strong labor market, unemployment rate at 3.5, unemployment insurance claims very, very low, and probably lower than 2017, 2018, 2019 for this time of year, if you take out the hurricane. And the labor market conditions index as put together by the Kansas City Fed would say that this is the best labor market that we've had since the late 1990s and one of the best labor markets we've had in the entire post-war era. So I think on the employment side of the mandate, we're in great shape.
Okay.
So it's a great time to be fighting inflation, and it's a great time to try to nip inflation in the bud and get it back to 2%, or going in the right direction back to 2% while the labor market's strong. So I think we've got a shot at that in 2023.
You read my mind, because the next thing I wanted to ask you about was you seem to be holding out hope for a soft landing. Now, it seems like other officials at the Fed have kind of accepted or seem to be saying, yeah, we are going to have pain. We're going to have to endure pain to get the to get inflation down, which people tend to interpret as recession. Maybe just mild, but maybe something deeper if necessary. Is that why you still think that a soft landing is possible when so many people have said, look, you've got to be more restrictive. You've got to get inflation down. You've got to get the funds rate well above inflation. But this sense that, no, this is a pretty strong economy and it can hold up.
Yeah, I don't know. There's a big group that wants to talk in terms of a Phillips curve, but the Phillips curve has been flat for the last 20 years. So I'm not sure where the disinflationary pressure is going to come from that channel. You'd have to have, the estimates of the Phillips curve are that, even a percentage point on the unemployment rate has barely any impact at all on the inflation rate. So it's a little puzzling exactly where the story is coming from. Do they think, I would challenge them to say, well, do they think it's a nonlinear Phillips curve where the effects get much more serious as unemployment rate goes up? And that's maybe something you could say, but that's not really in the data. So I don't think that's where the disinflation is going to come from. I think it's going to come from the product side. side of this process where firms worry about loss of market share, and for that reason they do not want to increase prices as rapidly as their competitors, and this leads to a 2% rate of inflation instead of a 8% rate of inflation.
Okay, but what about inflation expectations? What about the fact that inflation is so far above wages right now?
Because inflation expectations are looking good right now, at least based on TIPS markets. They've come down below 3% for the 5-year and the 5-year forward. Those are good numbers considering that the headline inflation number is at 8%. So I think we do have the right expectation in markets, and we do have the right policy in place. We're going to the right level of the policy rate, and I think we can get this dynamic to work. I don't really think it's going to work through labor markets the way other people think. And I would say one other thing about this. The unemployment rate's at 3.5%, so most people would have the natural rate of unemployment somewhere in the 4% range, let's say 4.5%. So if unemployment just reverts to mean and goes to 4.5%, that would just be mean reversion in the labor market. You wouldn't expect the labor market to be at stellar levels, which is where it is compared to the post-war experience forever. So you'd expect it to revert. So that would be somewhat more unemployment. But that would not be, would not help, according to the flat Phillips curve, it would not help us that much on the inflation dimension.
Inflation expectations, University of Michigan Consumer Survey, which is a very closely watched, as you know. Right now, this is very interesting, 25% of the expectations in the U of M survey see inflation at 4.8% or more in the next 5 years, but that's the top quartile. The bottom quartile sees it below 0.7% for the next 5 years. It's the largest gap between the top and the bottom of those quartile boundaries since May of 1991. What does that tell us? There's a big, how do we gauge or how can we be confident on inflation expectations? And the market's break-evens change all the time.
And they can't be wrong.
Right?
Yeah.
So.
Yeah, I think this is fascinating. I think there is some uncertainty about what's going to happen, and we're being, as a central bank, we're being challenged on the inflation front, and we're trying to get a really good policy in place to get inflation under control. But, if you're out there as a household, different households might have different views about whether we're going to be successful or not. And that's why you see this big, this big divergence in the variance of inflation expectations.
And another thing about inflation right now, there's a massive gap between the CPI and the PCE. In fact, let me look at the data here. It's last time it was this high or higher was 79.82, and that was in the Volcker rate era. So you can target the PCE, that's your main measure. Can you ignore this big gap? And the CPI is so high, and again, so much above the funds rate. Is that a message you have to respect, that you have to deal with?
Yeah, I think, the inflation target is in terms of headline PCE inflation, so that's our main measure. And we did do a review of this, but not recently, only in the 1990s. The idea was that the PCE measure is a more comprehensive measure of all the prices in the price basket. And so we like to look at that, but certainly the CPI also informative and might match up with some households' actual expenditures a little bit better. So I think what happens is that when inflation goes to a higher level, these differences in measurement start to get magnified, and so you see some bigger differences between the different measures.
It's Homer Jones Memorial Lecture. He was one of at the St. Louis Fed, he is considered the person who brought research to another level that it hadn't been done before at the banks. Real leader, and that's been passed on. So if Homer Jones were here and he was talking to you and your team about this place you're in and how inflation got way out of control for many reasons, and now you have to bring it down, what would he be telling you? How would he be assessing your performance, and what would he be telling you to do now?
He'd probably be telling us we're doing a bad job. He is very data-oriented, and was the things that he did were the precursor of what we now call Federal Reserve Economic Data, or FRED. And I know a lot of the listeners and viewers use Fred, and we try to provide a great public service there. So, you know, he would be analyzing the data just like we were here and talking about the different components of inflation and how far it is above the inflation target and so on. I think, you know, there are a lot of differences from the earlier era. I think that at the time, it wasn't as widely accepted that central banks were responsible for inflation, but he emphasized that it is the responsibility of central banks. And I think the 1990s, he didn't live to the 1990s, but the 1990s are really the decade that vindicated that view, as you had central banks all around the world going to inflation target and getting inflation toward target.
Speaking of the 90s, that makes me think of the 80s. It makes me think of Paul Volcker. If Paul Volcker were here, what would he be telling you?
I think the Volcker era really brought about the idea that you need to be credible in your policy. And when Volcker started, the central bank didn't have any credibility at all, and so he had to earn it all from 1979 into the 1980s. But because he did that, I think we're starting off with a lot more credibility. We start off with an inflation target. He didn't have that. We start off with widespread acknowledgement that it's up to the central bank to run the right policy to get inflation under control. We start off with better understanding in the private sector that if you do get inflation under control, which he did, you, instead of having the volatile 70s era, you had this long expansion in the 1980s, then a recession, then another long expansion in the 1990s. So you set off this high growth, low inflation environment, which is very much what we'd like to do now.
We challenge the investment status quo by challenging each other. Welcome to the power of independent thinking at scale.
Welcome to Wellington.
Wellington Management. Invest in unique perspectives.
It seems like every time we get together, there's something in the background. There's something big going on. And I would say this time is the fact that the latest inflation data have been disappointing. You've done 300 basis points of rate hikes since March. The core CPI basically is stalled out. The headline CPI is stalling out just over 8% year over year. Core number continuing to rise. And the employment market, the market's still tight in terms of jobs and the economy not slowing down. So what's gone wrong? All those rate hikes, what have they done?
Well, I do think they will have an impact, and in some ways have had an impact. I would cite the housing market in particular, where it appears that increase in rates has really changed the dynamics there. So that's someplace that I would say there are not long and variable lags. That market anticipated Fed moves that before they were even in train this spring, and so that's a place where we've seen impact right away. But it's a big ship, and it takes a while to steer the ship, and so the housing market is not the whole economy. So
it certainly isn't, and it's certainly not one of the main things driving inflation now. Of course, prices have fallen, but
rents are important, though.
Well, they certainly are.
Yeah.
They certainly are, and in fact, that's one reason why people are so worried about inflation staying high next year, is that those rents are, the way they are calculated, they're going to spread out over several months.
Yeah, but we're aware of the lags in the calculation, and so we'll take that on board and take a look at that. But yeah, you're right. The core measure of PC inflation is still in the high fours, and the Dallas Fed trim mean 4.75 or so. So pretty high inflation in the U.S., even if you try to trim out some of the more volatile components. So we're going to have to get that turned around, moving in the right direction, back toward 2%.
So how are you going to do that? What does this mean for the restrictive terminal rate of the September SEP's medium target interest rate, 4.4% this year, 4.6% next year? After the latest data, what are your projections now?
Well, if you look at the September Summary of Economic Projections, that so-called dot plot, it did seem that the committee was coalescing around further rate increases at upcoming meetings, even by the end of the year. So that seems to be the base case right now. Most of that has been priced into markets, so I would anticipate that that's having an impact right now. So that's good news if you're trying to get inflation down. But we'll have to follow through on that in the subsequent meetings this year and get the policy rate up to a level where we can put meaningful downward pressure on inflation. I think that's the main goal immediately ahead of us at the committee.
To make a real impact, we need to go from 25% renewables to 70 to 85%. Digitization and decarbonization go hand in hand. 5G will really pioneer a much more sustainable future.
And Neil Kashkari, they're also very conscious of the balance of risks between the Fed doing too little and doing too much, isn't he?
Yeah, so Neil Kashkari made the point that he expects inflation to come off over coming months, and of course that might give the Fed breathing space, say, next year to ease up on the rate hiking cycle. Now, there was, though, some nuance in his messaging, like you're saying, Paul. He was making the point that, however, right here and right now, he's not comfortable with where core inflation is at. We know the core inflation at 6.6% is at a 40-year high in the US, especially because of increases in food and energy prices. And Mr. Kashkari said two things. He wants to see core come down before he starts to feel any kind of degree of comfort. And as you mentioned, he said he's willing to do more than do less when it comes to jacking up interest rates to get inflation under control. So, you know, there was a headline takeaway that he does see sort of light on the horizon at some point, maybe next year when the Fed can ease up, but that's a next year story. For now, he's talking about, just like Jim Bullard mentioned, they have a lot of work to do, and it does mean more aggressive hikes this year, and that's why the market is priced in for at least 75 when they meet on November 1 and November 2.
And of course, we're also going through the beige book today, not to mention last week's Fed minutes as well, and discovering that U.S. output, potential output being revised down significantly. How important are these words?
Well, the beige book is really interesting because it's a liaison with the central bank officials and the real economy, companies, producers, manufacturers, and intelligence coming back picked up a couple of things. They're warning that they are slowing their hiring intentions, and remember, that's really important because the US jobs market has been the standout pillar globally in terms of the global slowdown. So any sign of cracks there will be important. So some warning from factories there. They're also talking about it's difficult to pass on the price increases that they're suffering to customers the way they were. Customers are now pushing back, so that means they're going to have to absorb some of that pain in their margin. And there was an uptick in references to recession in the liaison with factory owners and company owners among the Fed officials. I think there were 13 references to recession this time around. So all told, you know, it's not pointing to an economy falling off a cliff or anything like that, but it does point to concerns, and it certainly will add to the case that those people who are warning it takes a while for interest rate hikes to hit the real economy. There is that lag effect. A lot of people think the real pain in the US will come 6 months from now, and perhaps that's what the beige book is hinting at.
I wish that I could tell you. I wish that I could tell you.
On October 13th, the latest read of CPI came in at 8.2% year over year. And although this was 0.1% lower than the previous month, it was slightly higher than the anticipated 8.1%. As expected, the initial move in risk assets was lower, with NASDAQ futures losing over 3% and Bitcoin falling almost 4%. An odd thing happened after that, though. Both assets quickly changed direction and rocketed higher, with Bitcoin gaining 12% from its lows and the NASDAQ 7%. Of course, the dramatic turnaround could be a function of market position if many traders went into the CPI data with short positions, but maybe it's something else. Although two-year yields moved swiftly from 4.28% just prior to the CPI up to 4.5% just after, they've appeared to stabilize since. Also, the CME FedWatch tool has changed expectations for the Fed going into 2023 in that they've added a quarter point of expectations for a terminal rate up to 5% to 5.25% by June. They now predict that rate cuts will come sooner than previously anticipated, potentially as early as July. Going forward, traders will be closely watching any Fed rhetoric or inflation data for further clues to the potential rate path.
If this Fed sets the stage to go from 75 to 50 to 25, Rick Reeder and I spoke about this moments ago, is that sufficiently good enough for you to add to equity exposure?
No, Jonathan, I don't think so. I think it might be sufficient to create some sort of short-term bounce back, and that's what we've seen play out in the markets this year. But the reality is this is the Fed that is heading into restrictive territory, and the markets need to account for two factors. First of all, we're going to have depressed valuations. There's no reason for that multiple to expand, so that can't be the driver of equity returns when the Fed is clearly holding rates in restrictive territory. The other thing that's going to happen, we are already, this economy is sort of on the verge, on the brink, and as rates rise across the board, there's going to be more slowness and potential for a recession. So the markets will have to price that in, and that means the EPS downgrades are likely still to come. So even if we get some sort of a pop because of a so-called Fed pivot, the reality is the relative value of equities is quite challenged when rates are close to 4%.
Your take on this particular jobs report?
Yeah, Lisa, I think you hit it on the head earlier in your reaction to the unemployment rate and the labor force participation rate. I think that's why you're seeing, a little bit of negative reaction in the front end of bond curves, a little bit of negative reaction in in equity futures. I think this is a slight disappointment relative to hopes that, this report would give a piece of evidence in favor of the camp that there's a slowdown and a pivot underway. And I think that's going to be disappointed in this report. It's one report. It's probably not even the most important report. Next week, we'll get the most important report, which is the CPI report. But I think in total, that's really the numbers that sort of stand out to me is the failure to see an increase in the participation rate. And that's really about the forward-looking view on wage pressures. So yes, the wage pressures didn't go up, but they're still exceedingly high. And while they stay high, that is the source of the other camp's view, which is that we're in a wage price spiral. So I think it's a little bit disappointing to the dovish camp, a little bit reinforcing to the hawkish camp. Minor on both sides of the argument, but definitely tilting that way. And that's why you're getting the market reaction you are today.
So we get a lot of fund managers on the show, and they always say, we're not trading every day. We're not an algo. And they say, we have a certain approach and we kind of move along. How has your approach shifted as you get the multitude of data that we're getting? And how much are you looking to change it heading into year end?
Well, it's a great question, Lisa. And the issue is the degree of uncertainty here with regards to the inflation outlook. And it's very hard to forecast. So we have a little saying, if you don't have a good forecast, then observe. It's sort of what the Fed is saying in terms of being data dependent. They don't know what the trajectory of inflation is going to be, and so they're going to observe. So it's very hard to kind of trade every little change and turn in the data. We take a step back and we look at the overall trend. And as I just highlighted, this is one piece of information that's a little bit in the camp of the hawkish camp that the Fed needs to do more. But no one really knows where inflation is going to go, and we have expectations, however, in the bond market and the consensus view of a relatively benign amount of impact to the economy for a dramatic decrease in the amount of inflation. And I think the weight of the proof of that being the correct view is on that side of the argument. And so I think it's highly uncertain, and today is a little bit on the hawkish side.
Your thoughts on this report?
So I think exactly as you were describing, it's going to keep the Fed on track for a 75 basis point move at the next meeting. It's broadly within the parameters of what they were expecting. As you had said, that they were hoping that they'd still see a little bit more uptick in labor force participation, but they didn't get that. They do, I think they are expecting that the unemployment rate will start to move up a bit. Something that'll be heartening is that we didn't see an acceleration in wage growth. So that isn't taking off. That would be the most problematic thing for them, because that would suggest inflation expectations or inflation really becoming quite entrenched. And so I think that's the other key thing to be looking at going forward. Where is wage growth going? And so far that at 5%, obviously that's higher, much higher than it has been, but certainly lower than pretty much any measure of headline inflation.
Randy, I want to stick on participation rate for just a minute. We haven't gotten back to the pre-pandemic levels, and a lot of people were hoping for a soft landing, where you have more people come into the labor market who were sort of sitting out during the pandemic in the direct aftermath. How does this rejigger the expectations of the Federal Reserve, of this labor market, and how much it's been transformed post-pandemic?
Well, I don't think this one report is really changing that, but I think they're gradually coming to realize that a lot of people are just not coming back in. For example, older workers, labor force participation had been quite high before the pandemic, and now it's significantly lower. Older workers found a lot of people that they knew didn't make it through COVID. They want to be able to spend time with their families, and so I think those they're much less likely to come back in. And that's a challenge for the labor market, because those are the most skilled workers. And this is one of the challenges that we're seeing now, this skill mismatch, that there are a lot of openings, but there aren't people who have the right skills for those jobs.
Randy, I just have to point out this tweet from Ivan the K on Twitter. Reminder, be sure to fit today's labor market report into your narrative, even if you need to use a shoehorn. How does the narrative change, or what should the narrative be heading into year end as we look at the multitude, the totality of data, and try to understand where we are in this economic cycle?
Well, I mean, we're fortunate that we still have a very strong labor market, and so people have a lot of job opportunities, despite the Fed having moved interest rates up so much and so quickly. But as I had said before, monetary policy has impact with long and variable lags. So typically it starts having an impact in about 6 months or so, and we're getting to that point. So I do think that we're going to start to see the labor market weaken through the rest of the year. But the Fed's going to keep at it. There's nothing in this report that is going to suggest to them that they need to pull back. They're going to continue full bore towards 4+ by the end of the year, and then somewhere in the mid 4s or so they'll closer to 5 they will stop. But that will then depend on the data and how things are evolving next year, and also the uncertainties of what Mr. Putin might do.
You could manufacture a whole new way of manufacturing. Disrupt buying habits before they disrupt your business, and fuel the search for what comes next. So, what are you waiting for?
Well, we come in almost bang on, John. If you're looking for 263,000, you've won. And the Fed might be looking for a number about that level. That's the change in non-farm payrolls from the month before. Private payrolls up by 288,000. The forecast was for 255 on the headline, 275 on private, so we come in very close to what the consensus was. The unemployment rate drops to 3.5%. Guess there is that we had fewer people who were looking for work. We'll take a look at that in just a second. Average hourly earnings up 0.3 on the month, and that pushes the year-over-year number down to 5%, which was what was expected. The labor force participation rate drops a tick to 62.3, so that's probably why we're seeing the unemployment rate do what it did. The change in private payrolls last month was revised down from 308 to 275. So it looks like we're getting some little bit weaker numbers. This is the kind of drop, a sequential fall that the Fed would be looking for to suggest that their medicine is kind of working, starting to at least.
your thoughts on this report?
So I think exactly as you were describing, it's going to keep the Fed on track for a 75 basis point move at the next meeting. It's broadly within the parameters of what they were expecting. As you had said, they were hoping that they'd still see a little bit more uptick in labor force participation, but they didn't get that. They do, I think they are expecting that the unemployment rate will start to move up a bit. Something that'll be heartening is that we didn't see an acceleration in wage growth. So that isn't taking off. That would be the most problematic thing for them, because that would suggest inflation expectations or inflation really becoming quite entrenched. And so I think that's the other key thing to be looking at going forward. Where is wage growth going? And so far that at 5%, obviously that's much higher than it has been, but certainly lower than pretty much any measure of headline inflation.
Randy, I want to stick on participation rate for just a minute. We haven't gotten back to the pre-pandemic levels, and a lot of people were hoping for a soft landing where you have more people come into the labor market who were sort of sitting out during the pandemic in the direct aftermath. How does this rejigger the expectations of the Federal Reserve, of this labor market, and how much it's been transformed post-pandemic?
Well, I don't think this one report is really changing that, but I think they're gradually coming to realize that a lot of people are just not coming back in. For example, older workers, labor force participation had been quite high before the pandemic, and now it's significantly lower. Older workers found a lot of people that they knew didn't make it through COVID. They want to be able to spend time with their families, and so I think those they're much less likely to come back in, and that's a challenge for the labor market because those are the most skilled workers. And this is one of the challenges that we're seeing now, this skill mismatch, that there are a lot of openings, but there aren't people who have the right skills for those jobs.
Randy, I just have to point out this tweet from Ivan the K on Twitter. Reminder, be sure to fit today's labor market report into your narrative, even if you need to use a shoehorn. How does the narrative change, or what should the narrative be heading into year end as we look at the multitude, the totality of data, and try to understand where we are in this economic cycle?
Well, I mean, we're fortunate that we still have a very strong labor market, and so people have a lot of job opportunities, despite the Fed having moved interest rates up so much and so quickly. But as I had said before, monetary policy has impact with long and variable lags. So typically, it starts having an impact in about 6 months or so, and we're getting to that point. So I do think that we're going to start to see the labor market weaken through the rest of the year. But the Fed's going to keep at it. There's nothing in this report that is going to suggest to them that they need to pull back. They're going to continue full bore towards 4+ by the end of the year, and then somewhere in the mid 4s or so they'll or closer to 5 they will stop. But that will then depend on the data and how things are evolving next year, and also the uncertainties of what Mr. Putin might do.
この辺のグッズもサトフルだよ。サトフルに囲まれてサトフルいただいて。
俺最近もう豊本ん家がふるさとって思い始めてる。
言い過ぎだろ。
さっきもただいまって言ったし。
いいの？
ふるさと納税を始めるならサトフルで。
Are you going to pivot? Is the Fed going to change its rate path because the markets are nervous?
We are resolute at raising the interest rate into restrictive territory so that we can bring inflation down, which is causing millions of Americans to suffer real pain, and everyone's experiencing it. It's also very damaging to the economy to have this level of inflation, so we're committed to bringing it down and staying the course until we're well and truly done.
Well, when we were speaking before the interview, you said that the futures market hump shape, the idea that you go up and then you come back down next year, is wrong.
Yeah, I don't see that happening at all. I see us as raising to a level that we believe is restrictive enough to bring inflation down, and then holding it there until we see inflation truly get close to 2% and demonstrate that price stability is restored.
Well, what is that level that's restrictive enough?
Well, right now we've just got the rate up to a point where it's a little bit restrictive potentially, or just at neutral. And so I would see more policy adjustments as required to restrain the economy sufficiently. Remember, this is all about bringing demand, which is very strong, back in line with supply, and bringing inflation down. So I do see more rate increases as necessary. But of course, we're consistently data dependent, and we'll continue to do that.
Well, I know you tell me because you're data dependent, you haven't made a decision about what you want to do on November 2nd.
That's correct.
But what's more important right now, the speed at which you get to the restrictive level or the length of time you leave it there?
To my mind, the length of time we leave it there is increasingly important, because that's really going to be the thing that brings inflation not just coming down, but achieving that 2% average inflation target that we've set.
Well, how do you see the pace, the path of inflation now? Some argue that with supply chains normalizing, energy prices down, we'll see the CPI inflation collapse fairly quickly. Others say it's going to be stubborn and be there for much longer than maybe the Fed and others anticipate.
Well, you really have outlined the case for data dependence, because the data will tell us. What I see is that inflation will release some of the pressure we've seen this year, but probably end next year at closer to 3% than 2%. And then it will take another year to fully get it back down to our 2% target. Now, if we get better numbers than that, well, that's terrific. But we have to be prepared for inflation to be a little more persistent, because it has been a little more persistent than I think most people expected so far.
Well, a lot of it is on the supply side, and you work on the demand side. So there's an argument or a fear out there that because you can't affect the supply side, you're going to have to tighten more, and basically you need a recession in order to bring down inflation.
Well, absolutely, those are things that people fear, but let me just get some of the facts that we're dealing with straight, basically. So, we can estimate how much of the excess inflation we observe is really related to demand factors or supply factors, and many people do this, but we do this in San Francisco on a monthly basis. And we're really still seeing about 50% of that inflation is coming from demand, the other 50% from supply. So the hope is, of course, while we're bringing demand back in balance, we're eliminating that 50%, supply chains continue to recover, as you mentioned, and we really get that meet in the middle, and we find ourselves in a situation where the economy's back in balance and Americans are feeling the relief of lower inflation.
Well, how do you factor financial markets then into your policy making? Markets go up and financial conditions ease, works against what you're trying to do. Do you need investors essentially to lose money in order to get where you need to go?
Well, the way I think about it is markets are trying to think about a lot of information. They are thinking about the domestic economy, the path of policy, the incoming news about firms, the global economy, and they're trying to put all that together, and then they're making their bets on where the things are going. And so they're finding their footing, and that's volatility is, I think, a reflection of finding footing. For us, the path has been very clear. We're going to raise the rate until we get into some restrictive territory, and then we're going to hold that rate there. You saw that in the last summary of economic projections, and the chair talked about that in his press conference. It really is this idea that you hold for a while so that we can see inflation come back down. And our path is not really changed. We haven't pivoted on that. We're resolute at restoring price stability. And again, I just want to underscore this, giving relief to the millions of Americans who are suffering, and giving relief and fundamental strength to the economy. We're in a vulnerable position when we have high inflation.
How do you know whether you've gone too far? The feeling is the Fed raises rates until something breaks. Are we close to anything breaking?
So we definitely don't raise rates until something breaks. We actually are forward-looking, very forward-looking. You have to be. And that's one of the things about data dependence. You can look at the data that's published. Those tend to be backward-looking. But a lot of the time I spend in my job is actually out talking to business leaders, community members, small businesses, workers, and asking, where are we in the economy? You put that together, and you're constantly calibrating through this data dependence two risks: not doing enough and having inflation expectations drift because inflation just won't die off, or doing too much, oversteering essentially, and causing unnecessary downturn that isn't relevant for the economy and the conditions we're trying to achieve. So we're constantly monitoring both of those risks. And I guess the main thing I want your listeners to know is it's not a backward-looking enterprise, it's a forward-looking enterprise. We don't want to wait till we got there and then say, uh-oh, we want to get there as smoothly as possible.
We are speaking with Mary Daly. She is the president of the Federal Reserve Bank of San Francisco. What's the danger that you run into something that the Bank of England had to deal with last week of some sort of financial derivative that you hadn't been watching or that people weren't aware of suddenly blowing up?
Well, certainly you have to look out for those things, and in a time period when there's not just a U.S. tightening policy, but the central banks across the globe are tightening policy, and it's a synchronized but not coordinated tightening. All central banks make policy for their own countries, but we all are just happening to face that same high inflation for many of the same reasons that we are facing it here in the United States. That means there's global tightening, and that means firms and sectors are repositioning. So we have to be on the lookout for that. And the Fed always has several roles that it's managing at once. The principal one that you're hearing about right now is monetary policy combating high inflation, but we always have the lender of last resort responsibilities, and if market dislocation should come about, then we would be prepared to use that. But that's not what I'm seeing right now. What I'm seeing is an economy that's actually working well, but we have high inflation, and we've got to get that down so we can have sustained growth going forward.
You mentioned the hiking cycle around the world. There's an argument that perhaps central banks should coordinate because as you all raise rates, you get a tighter global economy and perhaps a greater danger of global recession.
Well, there's a difference in coordinating and being thoughtful about what central banks across the globe are doing. The central bank in the United States and central banks across the globe, but let me talk about here, the Fed, our mandate is to do monetary policy for the domestic economy. Those are the mandates Congress gave us. Those are the ones we uphold. We do that through price stability, full employment. We absolutely have to take account of the fact that when there's global tightening, the global economy is going to slow, and that will be, of course, affecting and spilling over to the U.S. economy, just as our actions spill over to other economies. And we have to take those things into account, and we do. But coordinated monetary policy is not something that countries do, and most countries don't want to have their central banks working with others. And the academic literature is actually out on that. Some would say that this could work, others would say coordination isn't going to work. The most important thing that I know today, though, is the mandate Congress gave us is to make monetary policy for the domestic economy.
Well, this is the biggest domestic economy in the world. The dollar is the reserve currency of the world, so what you do has a major impact around the world. The United Nations came out earlier this week and said you need to stop what you're doing because you're going to put the world into a recession.
We really have a domestic charter. That's what Congress gave us, and so we have to stay on our case. The other thing I know is that when the U.S. is a reserve currency of the world, and there are many things going on besides global tightening. We have the war in Ukraine. China continues to struggle through COVID. There's slowing across the globe, and that often brings people into U.S. currency. So those are just things that happen as a natural part of the economy and the dynamics there. But the Fed stays resolute to its mission, the mission that Congress gave us, price stability, full employment. We're obviously achieving on the full employment side. We're missing on the price stability side. We have to bring inflation down.
People ask whether, at this point, interest rates are the proper tool to deal with the problems that we have because they're such a blunt instrument and people will lose jobs or we risk a global recession or whatever. What do you say to that?
This is the tool we have, and it is a blunt tool, and that's why we're so careful about how we're thoughtful about the data. We are constantly out talking to people, looking at the information we have. It's not just about looking at a model and making a rule. It's really, the regional reserve banks, there's 12 of us. We spend a good portion of our time talking to leaders, business leaders, community leaders, workers groups, to try to find out what the economy is. And here's what I'm hearing to a person. That when you're out there talking in the communities, just in Boise, Idaho, people right now are worried about inflation, and they want inflation to come down. They recognize that's a major pillar of a well-functioning economy. And one young man said to me, I have plenty of jobs, but I only have 24 hours in a day and 7 days in a week. And every time I work, I lose money because I go to the store and I can't afford anything. So really the main message here is inflation is problematic, and we are committed to restoring price stability.
The there is a member of Congress, shall we say, who suggests that you're going to put millions of people out of work in this quest for price stability when you could accept a little bit higher inflation and not have such an impact on the labor market.
So I want to mention two things that are really resonant for me. If you look at this context that we're in a strong labor market, it is true people can find jobs, but average real wages in the United States, that's across everybody, the average real wage has fallen 9%, adjusted for inflation, real wages, 9% in 2 years. To me, that's not sustainable. People want to work and hold their value of the dollar, so inflation must come down. The other thing that I think is really important, we saw it in the JOLTS data that came out yesterday, there are several ways the economy slows and the labor market slows. One is that vacancies come down, and we saw that happen yesterday. People just post fewer jobs and there's less demand for workers, so you get less pressure, less churning. The second is the pace of hiring slows, and that's well before we see layoffs. Initial claims for unemployment insurance have remained fairly low, which means we're not really seeing a lot of layoffs. We're mostly seeing vacancies come down, and we'll see on Friday if hiring is starting to slow. But those are easier ways to slow the labor market than throwing millions of people out of work, and I think those are the first two ways that firms are using, at least the ones I talk to. Reduce vacancies, slow the pace of hiring. Right now, I don't hear a lot of talk about layoffs.
Mary Daly is the president of the San Francisco Fed. Friday, you mentioned the jobs report. What do you want to see?
Well, what I am hoping to see is some confirmation that what my contacts are telling me is starting to show through to the data. Now, yesterday's JOLTS report confirmed what they've been telling me. 2 to 3 months ago, they started telling me we're reducing vacancies, we're letting them roll off, we're not renewing them, and we're stopping our hiring intensity, we're slowing it down. Now they're telling me they're slowing the pace of hiring. So if that is showing up in the data, we would see a slower rate of job growth this time around on Friday than we have seen. And to me, that would mean the economy, the monetary policy is working, the job market is slowing, and that would be a welcome piece of news. Because while I don't want to see people losing jobs, I absolutely would like to see the pace of job creation come more in line with the pace of labor force growth. Demand, again, coming back in line with supply, and Americans getting some relief on inflation.
Let me ask you a question you got asked in Boise. Next week we get the Consumer Price Index. Will we see it starting to level off or go down? How long is it going to take to start to see progress on inflation?
Well, you know, I would have hoped we would have seen some of the progress in inflation already, because we have seen, as you mentioned at the top of our discussion, the supply chain starting to ease, but we haven't seen it so far. And the proof's going to be in the data. So, of course, we're eagerly awaiting that CPI number. I'd like to see core prices either stay flat or come down, you know, inflation not go up. Last time we had a surprise, it went up, not down. And, you know, I'm looking for that core number to really start to even out and come down, and that is going to be important to my own decisions about the appropriate stance of policy or pace of policy increases.
DUDA 初ハイクラス転職サービス DUDA-X 始まる。
Is it worth talking about the pivot, or do you want to laugh that off?
Yeah, I'm happy to talk about the pivot.
All right, so what do you think?
Then do. No, I think, you know, pivot means different things to different people. Is it when they dial down the rate cuts? Is it when they actually pause? Is it when they cut? And, you know, I think specifically for the Fed, we're in the camp at Nomura that it's still a long, long way away in terms of when we're going to see them pause. We don't think it's until after the March meeting. So we have the Fed funds rate going all the way to 5.5% by March. And I think the Fed, you know, the risk with the Fed kind of giving hints of a pivot, and we saw this a little bit with the RBA yesterday, is the markets are itching for that pivot. And it can ease financial conditions so much, particularly if the Fed does it, that it unwinds a lot of the tightening that they've been doing, and then they've got to kind of make up for that more. So I think they're going to be talking tough for quite some time yet.
And you've been coming up with kind of crunching the numbers about, you know, where are we likely to see that hard landing scenario? Where are we going to see maybe less vulnerable and a soft landing? What differentiates that classification, and who is most at risk?
Yeah, we thought we'd look at past tightening cycles, and we looked at lots of them, 110 in fact, across 30 countries. And we found some interesting things when we broke down after tightening cycles. We broke down the episodes which are hard landings versus soft landings. I think there was about 40 hard landings and about 60 or so soft landings. And what we found for hard landings was if you had, before the tightening cycle started, high inflation, or if you had excessive house price growth or high household or corporate debt, there was a bigger risk of a hard landing after the tightening cycle. And we also found during the tightening cycle, if I guess it makes a lot of intuitive sense, but if rates went up a substantial amount, there was a bigger risk of a hard landing. But also if the rate hiking cycle lasted for a long time, longer than average, there was a bigger risk of a hard landing. And by contrast, if the rate hikes were front-loaded, like happening early on in the tightening cycle, most of the hikes, there was a lower risk of a hard landing. So there was interesting differences, and we looked at all those. And then I guess what we thought was, hey, what about if we look at those features and apply them to what's happening in this current tightening cycle to see what's happening?
Rob, there's a real crisis out there, really, with energy prices. If you look in local currency terms, they're hugely higher than they would be in the US percentage, as a percentage anyway. This is going to take its toll. Coming against a backdrop, of course, of tightening monetary policy, it's creating a perfect storm, is it not?
Yeah, I mean, in our view, it is going to have a significant effect on economies, more so than we think central banks are letting on. So we are forecasting recessions. So to give you some numbers, for next year, we have GDP growth in the US at minus 1.1%. For Europe, it's even worse. For the Eurozone, we have minus 1.6, and UK minus 1.4. And negative growth in some of the other economies which have had big housing booms and large debt build-up, such as Australia and Canada and South Korea. So yeah, Rich, we think, you know, and it's not just monetary tightening, it's also fiscal policy is not being as supportive. There is a severe cost of living crisis. And there's a lot of what we're seeing in Asia, and I think it's going to show up more in the West. Asia's the big manufacturing hub. There's a growing unintended inventory build happening right now, and that means you need less production going forward. So it's all these factors.
What if China recovers next year? To what extent can that help? If, that's a big if, of course.
Yeah, it's a good question, David. We think, you know, China's economy, so it's extremely weak now, and we think it's probably going to stay weak for a few more quarters. But you know, come around second quarter next year, we do think, hoping that zero COVID strategy ends and we get more stimulus, China's economy will start to rebound, and there could be quite a bit of pent-up demand, as we've seen in other countries that have relaxed their restrictions. So China's very interesting. It's very counter-cyclical. It's interesting that most economies, nearly everywhere, are slowing down, and nearly all central banks are raising rates. The one exception where, you know, the economy's already slowed and rates are being cut and fiscal policy is being eased is China. So China could be the one that kind of bounces back before other ones in the world.
And Rob, you know, I think we've talked to a lot of some of your peers that have basically said, look, things are looking bad, but it's not as bad as what we saw in '97. We're not close to that. But how do you look at how this whole is going to play out? This whole kind of weakening of currencies on import prices. Does it be somewhat offset by the slide in energy prices? How much does that actually help?
Yeah, so we're getting questions like that from the investors now, with Asian currencies weakening, so just hinting, you know, is this the start of another Asian crisis? Our emphatic answer is no. I think Asian economies are in much better shape than they were back in '96, whether you look at foreign currency external debt, whether you look at FX reserves, current account positions, and just letting currencies be more flexible. So very different. That said, we are seeing aggressive Fed and we are seeing currencies weaken. I think what Asian policymakers are starting to do, I call it an eclectic approach. They've learnt lessons from the Asian crisis. They're not just going to be dogmatic and just focus on defending currencies or doing one policy in extreme. I think they're doing using multiple instruments. So they will let currencies weaken to an extent, but opportunistically they will intervene to smooth the currency depreciation. They'll also raise rates, and I think they'll use a whole bunch of kind of capital control instruments as well, whether it's new regulations on state-owned companies or taxes or macroprudential measures, things to throw sand in the wheel on capital outflows. So I think it's a combination of factors, and I think it's a much cleverer strategy that Asian policymakers have. And I think if they stick to it and are prudent with it, Asia's going to be in a very strong position to be one of the first regions to rebound from this mess we're in.
Gershon, this feels like lose-lose. A lot of people in this market are paralysed by this. We heard from Max Kettner of HSBC a number of weeks ago, who basically said, it's heads you win, tails I lose. Gershon, does it have to be that way? Is it bad? Bad if they hike and bad if they stop?
Well, it's certainly bad on the surface, but it always comes down to what's priced in. And, some of the strongest returns we've seen in markets, particularly equity markets, have been when things feel really, really bad. They felt really bad in 2002, in 2008, 2011 with the European debt crisis, and during COVID. The question is what's priced in. I will take slight issue with something Mohammed said. He's saying that the Fed will pivot if it becomes clear that the risk of recession is just too great. I think we're there already. I think the odds of a quote-unquote soft landing have really gone to close to zero here. There's going to be pain, question of how much, and the Fed has been clear they're going to keep on going, and other central banks are going to as well. So there's really no getting out of the economic turmoil, and growth is going to slow and weaken and even go negative, particularly in Europe. But the question is, how much is actually priced in right now? I think on the equity side, you can explain a lot of the decrease in PEs and the sell-off. There's the change in long-term interest rates. That really explains almost all of it. I think on the credit side, it's a little bit more nuanced, especially as most companies in the high yield market did not lever up their balance sheets over the past couple of years.
Gershon, last time you and I spoke, early August, you said we were too negative on growth, too confident that inflation would fall. Is that still the case for you?
Starting point matters. I think that the markets certainly are very confident. You look at where one-year break-evens are, it's like 2.4%. So if you think inflation is going to continue to be at these elevated levels, you can make a lot of money betting on it the other way. I think, look, inflation is going to come down. There's no question. Housing is already starting to weaken with higher mortgage rates. The consumer is starting to pull back. We're going to see inflation come down. The question is, how fast is it going to come down? And quite frankly, just like, central banks were late to the game here in raising rates, almost certainly they're going to be late to put the brakes on. That's just the way cycles work. It's not some magic that you change policy rate and the next month the economy changes or inflation changes. There's a huge lag effect. So, I think the risk of a quote unquote another policy mistake of going too far is there.
No matter how you look at it, we have a serious inflation problem in the U.S., and we're missing our inflation target, and the credibility of our inflation targeting regime is at risk. These levels of inflation are similar to levels that you would have seen in the 1970s or early 1980s. So this is something we have not experienced since the days of Paul Volcker. And the problem with the 70s was not just that there was a tolerance for high inflation, but that the inflation was volatile and the real economy was also volatile. There were 4 recessions in 13 years, culminating in the 1982 recession, which sent unemployment all the way to 10.8% in the U.S. at the peak. So this is a serious problem, and we need to be sure that we respond to it appropriately and not replay the very volatile era of the 1970s.
Stay at the surface, and the surface is all you'll see. Essential intelligence from S&P Global takes you deeper, where a more prosperous future is yours for the seeking. S&P Global. Seek and prosper.
Set us up when you think about a chair who on Wednesday, Jay Powell comes out and says, before I begin my speech, I want to say that my message has not changed from Jackson Hole. And that was a hawkish message that he was really trying to reiterate. How are you thinking about a new hawkish message and the impact on U.S. economics?
Jay Powell is doing what he thinks is right, which is talking tough to try to keep inflation expectations stable and to prep the market for more tightening. The problem the Fed has right now is, it, in some sense, waited too long to tighten. The economy already is weakening. We see that in the index of leading indicators, down 6 months in a row, 10 of the last 11 months. And Jay Powell and his colleagues are making the mistake of looking at the labor market, which now, because of COVID and the shutdowns and the reopenings, is really a lagging economic indicator. Markets are much more forward-looking. That inversion of the yield curve, 2s, 10s, which is extraordinarily flat, extraordinarily, I should say, inverted, that's a sign of liquidity rapidly leaving the market. You see it in the Treasury market in terms of bid offers and how much liquidity is there in terms of trading ease. And unfortunately, Taylor, the Fed is on the cusp of a major policy error and will likely be cutting rates and pivoting much sooner than people think.
Is that next year?
Yes, I assume it's next year. Because the tightening in monetary policy that we've had to date, this has been the fastest 6-month increase in interest rates since 1981. And we're seeing tremendous weakness in housing. We're seeing financial markets hemorrhage. We're seeing middle-class incomes collapse because of the higher food and energy costs, overlaid now with the tremendous wealth effect. But I believe the flow of funds data through Q2 had showed something like a 7 trillion decline in wealth. That's only gotten worse. The economy is getting hit by so many factors, and there's no global growth. China's slowing. Europe, led by Germany, is going to be in a deep recession. The emerging markets are suffering because of the dollar strength you highlighted. I mean, we're looking really at a very nasty recession that will take inflation down.
Can you size the scope of a recession? Because we did have, of course, the likes of KKR, Henry McVeigh earlier saying that it'll be a mild recession 2023. You'll get unemployment to 4.9%, for example. How much pain are we likely to see in a lagging jobs market?
I mean, I haven't been following Henry recently, so I don't know where he's been. But I can tell you that most of the people who are saying there's a mild recession fail to even see the inflationary recession we had earlier in the year when GDP has been negative for 2 quarters in a row. It's likely negative again this quarter. So to say at this point it's a mild recession, I'm not sure what that's based off of. What we know is that monetary policy works with a lag, and historically the Fed always overshoots. So it seems to me at this point, if we're looking like a mild recession such as 2001, that seems to be awfully, that's really a forecast. It's like a fairy tale forecast that could happen, but history would suggest that's not the case.
We were talking a little bit earlier, Joe, with Alan Blinder, the former Fed vice chair, and he was kind of talking about this idea of whether a soft landing could happen. And at least in with his research, he seems to suggest that a lot of the cycles, the tightening cycles that we've had, have been a lot softer than maybe the way the market interpreted. The idea here is that, yes, while there was some pain for the economy and, of course, some pain for markets, at the end of the day, if the mission is to fight inflation and you get it down, you avoid an even worse situation than if you just continue to let inflation run wild.
No, that's true. But again, a lot of this inflation is supply driven. We had excess fiscal stimulus, which is a problem that the Fed accommodated. And I'm not saying the Fed shouldn't be tightening rates. What I'm saying is that the Fed just focusing just purely on having to get rates higher as everything around them is crumbling is a mistake. When Alan was at the Fed in '94, they did engineer a soft landing, but inflation, as you know, was a lot lower, and the economy is much healthier. We've come off the 3% plus GDP rate the year before, and there was no inflation. This time around, much different. Productivity is a lot lower. You've got a lot of leverage and debt in the system. Aging demographics suggest trend productivity is less. So the Fed's ability to pull this off, those probabilities alone are low, overlaid with the high inflation. What I'd like Jay Powell to do is to be a little bit more agnostic about his need to continue to hammer the markets with tightening, especially as the Fed is doubling the pace of its Treasury runoff.
And just real quick, we only have about 15 seconds here, Joe. With regards to the credibility, at least is how you interpret the credibility of the Fed, are you satisfied at least with the communication, if not necessarily the actions?
No, I don't like what the Fed's done. It's too transparent in the sense that it's trying to control things which you can't control and things which you cannot forecast. So no, I don't think the Fed's done a very good job.
Water is the most important resource in the world.
수자원 관리는 반도체 산업의 환경 경영의 시작이자 반드시 필요한 단계라고 볼 수 있습니다.
So how do we make chips in a more environmentally responsible way to make every drop of water count?
And then I guess, everybody's trying to figure out what happens to the economy, broadly speaking, as we absorb all these interest rate hikes. I don't have the Canadian story right in front of me, but I do know, at least if you go back to the previous 3 rate hike cycles in the United States, in 2 of those instances, and yes, there were some, particulars that we were living through, whether it was the Great Recession or the internet boom and bust, but you had a situation where coming out of rate hiking cycles, you had sizable recessions, and that influenced the market, maybe 2015, 2018, a different scenario overall. Can you give us your best guess right now, whether it's Canada, whether it's the US, whether it's a mixed vote, maybe there's a difference between the two on the likelihood of a recessionary situation given all these rate hikes?
Yeah, you know what? I'll say that the likelihood of a recession is 99.9%. Why do I say that? The central bankers actually want a recession. When you look back in history, and as you mentioned, the last 2 rate hike cycles, you get a recession. The intent is to get a recession because that's the only way you reduce demand and you reduce growth and you reduce inflation. So the intent is recession. It won't be a policy. It may end up being a policy mistake, but the playbook says you have to get a recession. That is the key thing that the market has to get through to prepare themselves, both business, both household finances, and the like. What the question is after you say, okay, 99.9% of a recession is, what is the severity of the recession? Is it going to be mild? Is it going to be medium? Is it going to be hard? Right now, we're leading towards a medium, a mild to medium for 2023, but we think this goes into 2024. And if that does prove correct, it could be a hard recession. The reason why is, and this is one big difference from the 2 last rate hiking cycles, the reason why the central banks are hiking now is inflation. The reason why they hiked before was for other reasons, anticipating inflation. They didn't have inflation at 7-8%, let alone above 3%, right? So because of that, they have to hike more, which increases the chances of this being a more severe recession, not in 2023, but in 2024.
Let me move on to what Nassim Taleb said this week, which is real simple. All of a sudden, the gravity's back in physics. We've been working with physics without gravity. We're back to a risk-free rate. From Guggenheim, do you see the end of the zombie companies? They're going to be forced out over the next cycle.
Absolutely.
Yeah, to me, it's going to be stunning.
This looks a lot to me like the internet bubble. I remember...
But do we have companies with profits unlike in 99 and 00?
Today?
Yeah, we have some companies making money.
Yeah, we do. But we have a lot of companies that aren't. And, talk to me about EV companies that are out there whose whole business model requires that they keep raising capital.
A unanimous Fed raises the benchmark rate 75 basis points as anticipated and offers no sign that it is ready to stop tightening. The dot plot shows the median forecast for Fed funds next year, by the end of this year rather, at 4.4%, which suggests about another 125 basis points over the next 2 meetings, which leaves a 75 basis point move at the next meeting in November on the table. In 2023, the median forecast anticipates no rate cuts, but one more 25 basis point move to 4.6%. For the year, the committee says it was evenly divided. 6 saw 4.9%, 6 saw 4.75, and 6 saw 4.5. One member put the top rate next year and this year at just 4%. So there's still a possibility we see a lot more increases in 2023. The statement almost word for word the same as the one in June. Policymakers noting they are highly attentive to inflation risks and anticipate that ongoing increases in the target rate will be appropriate. There's a wide dispersion of forecasts for 2024 and 2025. The median suggesting that the Fed funds rate falls to 3.9% in 2024 and to 2.9% in 2025. That's because inflation takes longer to fall, not reaching the Fed's target until 2025, headline and core. This year, inflation headline 5.4%, core is going to be 4.5%. Next year, headline 2.8%, and in 2024, 2.3%, core 3.1% next year, 2.3% in 2024. Now, Fed officials also bumped up their unemployment forecast to a median of 3.8% this year, 4.4% next year, and in 2024, and 4.3% in 2025. Growth takes a big hit this year. Annual GDP marked down to just 0.2% from the 1.7% they saw in June. The economy will expand 1.2% next year, 1.7% in 2024, and reaches a 1.8% potential rate in 2025. Finally, as I mentioned, almost no change to the statement, just 2 words in the opening sentence. Recent indicators point to modest growth in spending and production. In June, they said those had softened.
$75 likely, $100 maybe. Is the question really, though, what comes after this meeting?
That's absolutely the question that everybody is going to be asking. Vladimir Putin is not around the table in Washington at the Fed, but he's certainly clouding the economic outlook. They'll do their best to provide us with their view of the path, however, after that 0.75 percentage point increase is announced. And by the way, that would be the most aggressive rate rise since the Volcker years. So the Fed is really going after it at this point. But it's the dot plot that's going to matter to the markets the most. The June dots were above market expectations, but they're way below now. So how much do 2023 and 2024 dots move up, and what's the peak going to be? We also get our first look at 2025. How long will it be before rates start to come down? Then we also get the summary of economic projections, their view of what the economy is going to look like, and that was all put together before Putin. Should lower their growth figures is the expectation. They were all below the neutral rate already, so those should go lower. The unemployment rate will be going up. How far are they willing to let it go before it gets to be too much? Inflation, how quickly will it come down? Look for those numbers to go down much more slowly. And the first time, of course, for the 2025 estimates, they won't be that accurate that far out, but it gives us an idea of what they think the path is going to be. And of course, finally, we get Jay Powell's news conference, and he's going to try to make sure there's no ambiguity. The Fed is going to stay on this path until inflation starts to come down.
Mike, do we get a sense that the commentary that goes with a 75 basis points move might have to be more hawkish to compensate for the few who expected 100 today?
I think what you'll get is something like Jay Powell in Jackson, where he stays focused on the idea that the Fed is going to raise rates, and they're probably going to raise rates aggressively, if not 75, then by 50 basis points at the next meeting or two, and not try to give markets any reason to think that the Fed will pivot. The markets are already pricing in, or still pricing in, cuts to the Fed funds rate in 2023, and he probably wants to take that off the table.
Michael Pond, if I look at the real yield and I look at 2 partial differentials of the nominal yield and some measurement of inflation, which matters right now?
It's the real yield that matters, and it's moved up a lot over the summer. The market was not really buying into the Fed's resolve to hike rates enough to slow the economy and getting inflation down. Since Jackson Hole, though, real yields have soared, particularly at the front end, where they were almost at zero earlier this month. Now they're above 1% when we look at short end forward. So the market's moved a lot and really accepted the hawkish tone of the Fed.
So if I look not at the 10-year real yield, but Michael Pond, let's go shorter to maybe the 2-year, if you agree with me on that, from a negative 300 basis points inversion to a positive 164 basis points. That's a hugely linear jump condition. How do other asset classes react to the Michael Pond world?
Well, risk assets do not love higher yields that are not supported by strong growth. Really, where real yields are rising here is because the Fed has become much more hawkish, trying to slow the economy. And that's in part why risk assets have been on the back foot since Jackson Hole. So the Fed's trying to get the economy in a position where inflation comes down, and then it can take its foot off the brake a little bit and allow growth to go back up. Well, we think we're years from that. The Fed's resolve is strong here. That was clear at the Jackson Hole speech by Chair Powell, ripping up the script then and channeling his inner Volcker. Risk assets have responded, but now they're at the point where perhaps they've overreacted. You know, obviously we'll get a message from the Fed that's on the hawkish side, but markets are already prepared for a very hawkish Fed. So it's a delicate balance today.
As far as you see it right now, what would you project the so-called terminal rate to be? We've got the head of economics at Bloomberg saying 5%. Deutsche Bank says 5%. Where do you think we end up?
That wouldn't surprise me. Certainly at 450, there's more realism in market pricing than there was several months ago. I think we're more likely to end up above 4.5 than we are to end up below 4.5, and it certainly wouldn't surprise me if that rate has to get above 5 if we are really going to, in a determined way, contain and control inflation. Whether the Fed is going to stay the course and do what's necessary to contain inflation, we're going to have to see how that plays down the road. Rick Mishkin, a former Fed governor, had a very strong op-ed this week, making a point that I've made a number of times, that even Paul Volcker had a kind of false start on inflation containment, where he brought down rates in response to bad economic statistics in the spring of 1980, which then had to be reversed and forced us to have even higher rates than we otherwise would have had to have in the early 1980s. So I think it's not going to be easy to do what's necessary. But I want to emphasize something that I think is going to be hugely important in this debate. This is not at all about whether you care about unemployment or whether you care about inflation. This is not at all about how much importance you attach to disadvantaged workers or to shuttered businesses. This is only about what the right path is for minimizing the total of distress over a long time period. And just as the doctor who delays your surgery or doesn't prescribe you a full course of antibiotics or doesn't carry through on your chemotherapy does your health no favor and ultimately causes you more suffering, the question is how we maximize economic performance over time And history there points, I believe, very strongly to the need for us to be determined with respect to inflation. And that is very much the case when we've got inflation in this range. History records many, many instances when policy adjustments to inflation were excessively delayed. And there were very substantial costs to that, again and again through the 1960s and 70s, for example. I am aware of no major example in which the central bank reacted with excessive speed to inflation and a large cost was paid. And so I think that lesson, that in terms of minimizing the risk of a stagflationary catastrophe, the Fed has to be prepared to stay the course, is the important one to internalize.
Water is the most important resource in the world.
수자원 관리는 반도체 산업의 환경 경영의 시작이자 반드시 필요한 단계라고 볼 수 있습니다.
So how do we make chips in a more environmentally responsible way to make every drop of water count?
We've got mortgage rates, Bob, through 6%, maybe approaching 7%. Had a massive repricing of real rates. How long before this shows up in the economic data, Bob, economic activity?
Well, I think that's what the Fed is looking for. They do see that they're raising the cost of funding, so it's impacting auto sales, housing, and credit card purchases. But it's coming down from a very high level. And as Victoria said, corporate profit margins are still pretty good. And they put in place 2 years of ultra-low-cost financing in 2020 and 2021. And you've got a tight labor market. So they've got to pass along that cost. I think the Fed's watching all of this, and I think it's going to cause them to have to go further than even we think in hiking rates to really lean in to this kind of growth.
Is that a 5 handle on Fed funds, Bob?
Well, for now, we're at 4 3/4 is a minimum. So yeah, 5's definitely in the realm of possibility. And one of the things that we've looked at is the Fed has never stopped a hiking cycle with both headline and core inflation above the Fed funds rate. So they've always gotten to a positive real rate.
So, Bob, with that in mind, you've got the potential for 5% Fed funds. You've got a base case of a recession. Can you talk to me about the character of that recession? I get a lot of guests on this program, Bob. You've heard them, who talk up short and shallow. If we get one, it will be short, it will be shallow. Do you share that?
No, I don't. I think that you have to step back and say the Fed is fighting a 40-year inflation problem, and they and the other central banks are horribly offside. So they're going to be very aggressive in here. On top of that, we've had 2 years of ultra excessive liquidity at a very low funding rate. So when you have tremendous liquidity, which is costless, it bubbles up and gets leveraged somewhere. And as you raise the cost of funding, certainly as the Fed is doing to that magnitude, something will go pop in the night. We're keeping our eyes out trying to figure out where that is. But for sure, something's been financed with too much liquidity at too low a cost, and that will pop.
You like a 10-year at 355, 356?
Not in the least. If I look what the Fed's done so far, let's remember they've raised rates 225 basis points. We think they have more than that to go. They have at least another 250 basis points to go. So we're less than halfway through. The market's even pricing in another 225 basis points, so saying they're halfway there. I don't recall in what textbook it says it makes sense to fight the Fed.
What is fighting the Fed in credit then, right now, Bob? What about credit? Where does that leave things?
Well, Credit, I have to say, is a point of a lot of debate internally. Our high yield team, bless their souls, looks at the high yield market yielding over 8.5%. They look at default rates hovering close to zero. They see default rates, in a recession going up to 3 or 4%, and feel that at a 500 basis point spread, you're compensated for that. And we're saying wait until we get into a recession. A reasonable spread level for recession is 750 basis points. We think at a minimum, the Treasury curve will be at about 4.5%. That's a 12% yield with credit spread and where the Treasury curve is. That's substantially above the 8.5% now. So there's a lot of impatience in the market to take advantage of the repricing. We're not even in the recession yet. Let's wait till we get there.
Stay at the surface, and the surface is all you'll see. Essential intelligence from S&P Global takes you deeper, where a more prosperous future is yours for the seeking. S&P Global. Seek and prosper.
Kathleen, I'll start off with you. And of course, the Fed is front and center. It's interesting that between 50, 75 and 100, markets seem to think that 75 is the not too hot and not too cold Goldilocks point here.
Well, first of all, it's also still a very large rate hike. Granted, it'll be the third one they've done in a row if they do it. But 50 basis points now seems like something that's in the rearview mirror, at least for now. Inflation is high. It hasn't broken. The Fed has made it very clear, from federal bank presidents to governors, that they're very concerned about the inflation rate. So 50 basis points just doesn't even seem like, the debate is 75 and 50, isn't it? And the totality of the data, that's Jay Powell's words. When you look at the strength of the economy, it still has it, labor market, for example, and the hotness of inflation, that would argue for at least 75. I think that's the way to say it. But the reason why the 75 camp thinks that it is the reason, not only a reason to do it, it's why they should do it. Because look, if you do anything bigger, you're going to get people all worried about recession. They're going to start talking about rate cuts next year. Financial conditions will ease. Bond yields will rise again. It's going against the grain of what you need to do. So stick with 75. You're going to bring inflation down. Now, if you look at the arguments people are making for 100, I would say at the top of the list is you've got to restore your credibility. Look, inflation wasn't transitory. Now it's terrible. So this will help people realize that you are serious about this fight. You're not going to pivot too soon. And you need to get ahead of inflation. Stamp on it hard while the economy still has the strength not to be completely stamped out. Maybe you then could open the door to smaller November rate hike, that 50 basis point hike, because you're starting to get under control. You might impress the public that you're really so much that you're cutting inflation expectations. And a lot of people would say gradualism just ain't cutting it, you guys. The inflation rate is still way too high. You can't move there yet. And Jay Powell opened the door to a 100 basis point hike in July. He was asked a question right after they'd done a 75 basis point hike. And when he was asked about doing something bigger, like 100, here's what he said. He noted that, I'd say we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that that was appropriate. Do they think it's appropriate now? We aren't sure. And all the Fed speaking going up to it has been, again, left the door open to the latest data. The latest data have been hot. They've been strong on inflation, that is. They've been strong on the labor market. So one more thing to look at, though, is the fact that people are going to be very interested in the dots. The revised, it's every 3 months they revise their forecast for where they think interest rates were going to go. Big Wall Street firms have been raising their terminal rate. Goldman just raised theirs from about 3.75 at the end of the year to 4 to 4.25. That's the kind of thing the dots can confirm.
It's a little bit higher than anticipated, 0.1% rise for the month of August in the headline number, which is more than the flat reading that we had last month and less than the 0.1 negative reading that was expected, pushes the year-over-year rate to 8.3%. The forecast had been for 8.1%, so we're a little bit higher. We'll check into the details and see why that is. The core, which matters more to a lot of people, rises 0.6%. That is double last month and double what's expected, pushes the year-over-year rate to 6.3% from 5.9% last month. The expectation was for a 6.1% move. So some bad news on inflation here, but does it really matter? Because everybody was kind of expecting the Fed to go 75 anyway. Quick look at what some of the increases come from. Food is up 0.8%. Food at home, your grocery store, up 0.7. And energy, this is the one that was supposed to be the big wild card. Gasoline down 10.6%. It was up 44% on the year last month. Now it's only up 25.6% on the year. New cars are up by 0.8%. That is probably one of the disappointments in this number. Used cars fall 0.1%. There was a forecast that they would be down as much as 1% in this index, and so that is another disappointment. While prices fall, they do not fall as much as the wholesale price index had suggested. And then shelter, the rent component that everybody's been concerned about, that keeps rising even faster, up 0.7% after a 0.5% move last month. And on a year-over-year basis, shelter costs up 6.2%. So we are a long way from saying that inflation is conquered and has peaked, and so the Fed has still more work to do. Obviously cements a 75 basis point move.
Bill Dudley, why do the adults at the New York Fed, including you've lived it, why do you disagree with the doom and gloom crew?
Well, a couple of things that are very different this time. First of all, the Fed has the experience of last time to go by. Last time they were surprised by the demand of banks for reserves, and so they unexpectedly drove the amount of reserves too low relative to banks' demand. That's why you got the spike in repo rates in September 2019. So they've learned from experience. Second, they put in place a standing repo facility now, which is available just slightly above market rates. So if repo rates were to spike up, banks would turn to the Fed's standing repo facility. So you wouldn't see a big spike. It'd be a little spike this time. Lastly, I think the Fed's going to be tapering the rate of how its balance sheet shrinks as we get deeper into this process. At first, we're running off $60 billion of treasuries, up to $60 billion of treasuries and $35 billion of agency MBS each month. But once the reserves in the system get to a significantly lower level, the Fed's going to slow the rate of asset runoff, and then it's going to stop. It's basically going to stop. It's going to stop before they think we're at that critical point where reserves are too scarce. So they're going to learn from past experience, and I don't think they're going to make the same mistakes this time.
Bill Dudley, have we done this before? Is the New York Fed down in the basement? It's underneath one of the pizza parlors down in Lower Manhattan. Have you done an experiment that says this is going to work, or are you flying blind?
Well, I think you did the experiment last time following the great financial crisis. The Fed shrunk its balance sheet, and we had that experience in 2019 where they shrank it a little too much.
Right.
So they're going to learn from that episode and not do the things that they did last time. Last time, they never slowed the rate of asset runoff. They never stopped the asset runoff prior to the reserves becoming scarce. And I think this time, and they didn't have a standing repo facility. So I think this time they have sort of a belt and suspenders, and they didn't have either a belt or suspenders last time.
Unbacked cryptocurrencies as such, and those have not and don't appear to offer, have not offered and don't appear to offer much in the way of public interest in using them as payments. Let's say it's not a great store of value. What it is a speculative asset. Never take into consideration external political considerations. We are accountable to the public through Congress. That's a very fundamental, important aspect of our work. But we do not, we focus solely on the goals that Congress has given us, and that's what we're going to do here. I think it's worth going back and remembering, and I pointed this out in my remarks 2 weeks ago at Jackson Hole, 10 days ago, that what Paul Volcker did and the Fed did to finally get inflation under control followed several failed attempts to get inflation under control. And what had happened over the course of that long period of great inflation is that the public had really come to think of higher inflation as the norm and to expect it to continue. And that's what made it so hard to get inflation down in that case. So it is very much our view, in my view, that we need to act now forthrightly, strongly, as we have been doing, and we need to keep at it until the job is done. To avoid that, we think we can avoid the kind of very high social costs that Paul Volcker and the Fed had to bring into play in order to get inflation back down and set us up then for a long period of price stability. That speech, the point really there was to deliver a speech that was narrowly focused on inflation, more direct and a lot shorter than a typical Jackson Hole speech. And I thought that what was appropriate was a very, kind of concise and focused message. To your question, the message really was that the Fed has and accepts responsibility for price stability, by which we mean 2% inflation over time. That, again, to your question, the longer inflation remains well above target, the greater the risk that the public does begin to see higher inflation as the norm. And that has the capacity to really raise the costs of getting inflation down. So, finally, history cautions strongly against prematurely loosening policy. I can assure you that my colleagues and I are strongly committed to this project, and we will keep at it until the job is done. I can also assure you that we never take into consideration external political considerations. We are accountable to the public through Congress. That's a very fundamental, important aspect of our work. But we do not, we focus solely on the goals that Congress has given us, and that's what we're going to do here.
The Beige Book now moving across the wire. Economic activity unchanged, on balance since July. That's the main headline coming out of the new Beige Book being released today. The Fed Beige Book also saying that most districts saw steady consumer spending here. More headlines to come, to be sure. A lot of people, guys, trying to get a better read here on maybe what the Fed will have to debate when they go into that meeting in a couple weeks' time, particularly with the big inflation report up ahead and financial conditions. Certainly tightening, but maybe, at least according to some of the commentary we've heard out of Powell, not tightening enough.
It's like you're front running all my charts today. Take a look at a 2-year yield as we're focused on the front end of that yield curve, and a 2-year yield that was moving higher up until today. We fell a little bit, but again, the focus has been higher rates on the front term. Really, all eyes on the Federal Reserve. Remain front runs a 2C, a 220 chart on dollar and real yields. In the meantime, though, we take a look at the longer end. Take a look at this terminal chart, Romain. This is actually just the 30-year yield. Well, that's not my chart, but I wanted to show a 30-year yield.
Is Amazon really going to rescue today?
Oh boy, in for some headlines. The whole point is you had a yield curve that was rising, certainly to the highest since 2014, but they come down again. More news out of this Fed.
And just a couple of other headlines moving here with regards to the Beige Book. The Fed saying that in this survey, the outlook for future growth remained generally weak. Also says that price levels remain highly elevated. And it also says that employment rose at a modest to moderate pace. So not necessarily telling us anything new, but I think giving a little bit more ratification amongst the folks and the businesses that they interview and survey about their sentiment right now, Caroline, about this market.
Water is the most important resource in the world.
수자원 관리는 반도체 산업의 환경 경영의 시작이자 반드시 필요한 단계라고 볼 수 있습니다.
So how do we make chips in a more environmentally responsible way to make every drop of water count?
Restoring price stability will likely require maintaining a restrictive policy stance for some time.
The historical record cautions strongly against prematurely loosening policy. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those who are least able to bear them. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done.
I'm sure you weren't there physically in Jackson Hole this year. You were missed, of course, but you were certainly there in spirit, and I'm sure you were watching this as closely as everybody else. You know, a lot of people say he got a lot further than first base with this speech. Do you think it was a home run?
I think he hit exactly what he wanted to hit. The markets at first didn't seem to really believe him. When you looked at initially at the market reaction, it's like, oh, well, doesn't really seem to be much here. Then as they thought about it a little bit more, they said, this guy's serious. He just spoke for 8 or 9 minutes, and he had one message, and the message was really clear. We're going to keep at it until we're done.
What did Jay Powell realize between, say, his after the July meeting, his press conference, and Jackson Hole?
I think what you heard was a series of speeches by Fed officials, including some officials like Neil Kashkari, who had been very dovish and had said, well, maybe we should wait, we should be a little bit more cautious about raising rates. And even he said, we're going to be raising rates and we're not going to be pivoting anytime soon. So I think there was a very clear disconnect between the interpretation that the markets had put on what the meeting result was and what the FOMC members believed the meeting result was. And they were very, very clear, and I think Jay was super clear at Jackson Hole.
What's the risk here of over-tightening, and is over-tightening a bit like art? You don't know what it is until you see it.
Well, as Milton Friedman, my predecessor of many years at University of Chicago, had famously said, monetary policy has an impact with long and variable lags. So the Fed really just started getting going, taking the punch bowl away about 6 months ago. And so I think we're just starting to see more of an impact in terms of housing markets, in terms of we really haven't seen it in the labor market yet. My guess is we'll start seeing that over the next 6 months. And so that's why it's more of an art than a science, because we don't know exactly when it's going to have the impact and how much impact it will have. But I think over the next 6 months we're going to see. But I think the Fed, exactly as Jay said, they're going to bring rates up probably around the 4% or so area, and they're going to keep them there a while until they're convinced that inflation is coming down.
Well, we heard from Senator Elizabeth Warren. She's worried that this is going to tip the U.S. into recession. Is that a concern that you share, and how deep could that recession potentially be?
Well, it is a risk that there could be a recession. I mean, Jay had said, he says that they will have a period of below-trend growth, which of course could include a recession. People forget that the Fed's mission was to take the punch bowl away when the party really got going. Over the last 25 years, the Fed has always been there to provide support to try to cushion negative shocks to the economy. But that's just what central banks do. They have to take the punch bowl away at some point. And so, unfortunately, I think many policymakers have forgotten that that's ultimately what the Fed needs to do. How deep the recession, or if there is a recession, I think there is very much a heightened chance of recession. How deep it'll be, I think a lot of that's going to depend on Mr. Putin and shocks in the geopolitical sphere.
In terms of how high the rate is going to have to go, it's getting so that 4% is kind of middle of the road. Esther George was saying, sure, it could go above 4%. I pushed her on that, and she said, okay, because John Taylor said it. She said, well, yeah, you could. But number one, do you think they might have to go that high? And do you think that the Jay Powell has the will to lead them that high?
So I think it's very clear that they're on a path to get close to 4 by the end of the year, unless there's some other shocks that come in, or that we get wildly different prints on inflation over the last 3 months of the year. And then they're on track to raise rates a little bit more in the first quarter of next year. So I think that's going to get them to a 4 handle. Now, how much above 4 they will have to go, I don't know. That's going to depend on how inflation evolves. But I think Jay made it pretty clear that he's going to lead the Fed there, and he's going to hold the Fed there. They're going to wait until their mission is done.
I mean, there was a paper presented on quantitative tightening and all of its aspects, and a lot of discussion, Randy, about, you know, it's not that hard. It's pretty simple to do quantitative easing, right? But getting unwound is much more complicated potentially. How is that going to play out, and is it going to be one of the elements the Fed says, this is what we're using to tighten?
So the Fed likes to keep monetary.
With Needham's Laura Martin, she's one of the sharpest on the street. You don't want to miss that.
Welcome to Yahoo Finance Live. It is 11 a.m. here in New York City. I'm Akiko Fujita along with Inez Ferre. Here's what we're watching at this hour. A Meta slump. Shares of Facebook's parent company plummet to their lowest level since 2016 as investors turn sour on the social media giant. A struggling metaverse, Instagram woes, and concerns about regulation all weighing on the company's outlook. A positive move higher. Third quarter GDP in the U.S. comes in better than expected. The economy growing at an annualized rate of 2.6%, tempering increasing fears of a recession, at least for now. And got that sinking feeling? Not Twitter shareholders, apparently. The stock moving higher as Tesla CEO says he is ready to take the reins come Friday. We're going to talk about that a little later in the show, but let's take a look at the market action right now. We told you that positive GDP print that we got this morning, that's certainly helping with investor sentiment, at least if you look at the Dow and the S&P 500 right now. The Dow is up nearly 400 points. The S&P 500 trading pretty flat. The NASDAQ, the one to watch. We've been talking a lot about tech earnings all week. We're going to break down Meta in just a bit here, but we do have Amazon as well as Alphabet reporting after the bell. So we're going to be watching that one really closely, already under some pressure there. Well, shares of Meta are cratering after missing earnings estimates and seeing a decline in revenue for the third quarter. The media giant reporting its Reality Labs division lost over $9 billion so far in 2022 and forecasting operating losses in 2023 to grow significantly year on year. Meta joined the growing list of disappointing corporate results from tech companies. And Inez, there's certainly a lot to parse through here. I mean, we can start with that Reality Labs number because remember last year, this is a company that made that pivot. They changed the name of the company saying we're going to double down on the metaverse. And yet here we are saying that, look, they lost $9 billion so far, roughly $4 billion in the quarter. We heard a lot of use of the word patience on the earnings call yesterday with Mark Zuckerberg saying, we know this is a long-term bet. We think it's going to pay off. But certainly investors today saying, well, that's a long way out here. And I'm not sure where the company is headed right now when you think about so much of their revenue is still driven by digital ads. Things not looking as good in that direction.
Yeah, that's right. So you're seeing a slowdown in digital ads. We know the issues that Meta has also had with the iOS privacy issues. But the big problem is basically that you're saying long-term, believe us that we will be doing well with this metaverse investment that we're making. And investors are saying no. I mean, no, not especially right now. I think that the timing of this is very difficult for them because we are in a tighter monetary policy era. I know that Meta has big pockets, but still investors don't want to see this kind of investment in something so far out in the future when there's so much uncertainty right now. I mean, Facebook was a game changer when it came to social media. Will the Meta be a game changer for the metaverse going forward? That's yet to be determined. And Mark Zuckerberg is really asking investors to believe in him and this strategy, but it's far out.
Well, and the other thing to watch here is the regulatory environment. When you think about how Facebook and now Meta became the company it is and were able to grow their platform, a lot of it was through acquisition. You look at something like Instagram, you look at WhatsApp. Well, now they're in an environment where they're certainly not being embraced from regulators. They're not able to go out and acquire companies. And I guess the question is, if they could, is there a play they would make here within the metaverse? But that's going to continue to weigh on them too, because essentially they have to innovate their way out of all of this. And I'm not sure that the track record necessarily speaks for itself when you come to what they're doing internally versus how they've been able to grow through acquisition over the years.
Yeah, and metaverse is really something that, I mean, this should be more of a startup. This is what you're talking about is when you're talking about acquisitions. So which other companies would they acquire in this field anyways as well? I mean, this is
nascent, very early.
So early on. I do want to point out that when you take a look at the market cap of Meta right now, I mean, this is what also is scaring investors. We have seen a slow and steady decline, and right now in the S&P 500, it is number 21 as far as market cap is concerned. It's behind ExxonMobil, it's behind Chevron, Procter & Gamble, MasterCard, Home Depot, so it's fallen quite a bit.
Okay, let's keep the conversation going around Meta. We've got Laura Martin, Needham Senior Media and Internet Analyst. Laura, we Inez and I are talking about what we heard on the call yesterday. We didn't even touch on the digital ads part of it. Reels certainly one that Facebook, Meta has made a big bet on. They said they haven't been able to monetize it in a big way, but that was interesting in your notes. You said there was a deafening silence of this historical ad business that has been the big revenue driver over the years.
Yeah, I thought the most interesting takeaway was the silence. I thought the best question on the big call that everybody could hear was, you know, everything you're talking about is new. This all sounds very experimental. Why isn't it experimental to you? And what about the old business? And I think, you know, and I think Mark's answer was like, either he's not focused on the old business or he doesn't think there's a future in the old business. But nothing they spoke about yesterday actually is the business that today is worth 300 billion market cap and used to be worth 700 billion market cap. It's almost like he's walked away from the core business that is making historically has made all the money. I thought that was the most interesting thing from the call.
And Laura, I mean, when you're talking about walking away from the core business, I mean, should he be focusing on Facebook? Is this what investors want? They don't want this sort of experimental into the future, and especially during a time like this. Do you think timing has something to do with this?
I mean, I thought your point was fair that the market right now wants current cash flow. It wants to bring lower risk, so it wants cash on cash returns. I think the way I read his choices is he's worried there isn't a core business unless he can stymie TikTok. Like that he's worried TikTok is going to take away all of his content creators and his audience. And like MySpace, when you may recall, Facebook took all of MySpace's value away. It sounds to me like he's worried TikTok is going to take all of his value away unless Reels works, which is his knockoff of TikTok. So it just feels to me like this is a business at Facebook where every 10 years, Snap comes along and he has to copy it or die. TikTok comes along and he has to copy it or die. One of these days, you won't be successful copying the hot new thing. And I just wonder if there's actually a business here that is defendable.
Yeah, I mean, Laura, to that point, you know, we were talking about the tough environment Meta's already dealing with in terms of regulation. We know what the track record is with these acquisitions, whether it is an acquisition or taking an idea from another company. When you look at where they want to go with the metaverse, I mean, how convinced are you that the innovation internally is there to make this, even if it's long-term, a viable business?
Look, I think Facebook has realized, or Meta now, is realized that it doesn't control its destiny. It doesn't own its content because content creators are leaving it right now to go create content on TikTok and taking their fandoms with them. And it doesn't own its distribution platform because it's sitting on Apple, and Apple is capricious and arbitrary about changing its rules. And Apple doesn't really care if its rules hurt Meta. So I think Meta's answer to that is to let's create a new computing platform like AR, VR, glasses, where we are the platform background. We charge everyone else 30% and we change our rules capricious and arbitrarily and hurt apps on our platform. I think that's their play there. I think this really stepped up when Apple started making privacy changes in the fourth quarter of 2021. So I think he's realized, like a lot of apps have, that so long as Apple or Android control the policies on their platform and they are answering to regulatory fears on their end, and no app is safe. No app controls its destiny. So his play with the metaverse is to actually own the hardware that is the platform that consumers use. So he can charge 30% and change rules.
So, you know, with that said, Laura, what do you value this company at? Is it about the future play? Is it a metaverse play, or is it still a social media company that just hasn't been able to compete in an increasingly crowded environment?
I would say the latter, that I think it's hard to value because it's unclear there is a core business here if they can't successfully replicate TikTok with Reels. So I think the core business value is a big question mark, especially maybe outside the US is okay, but in the US it really is worrisome. And then the metaverse, you have to put in order to value this company, you must decide, is the metaverse going to work, or are we going to write off $10 to $20 billion a year in his spending until he figures out it's not going to work? So I think that's the issue with valuing this company now. It's hard to value the core business in a network effects business. It's going the wrong way. And it's hard to value what the metaverse will be worth, because at the earliest, he's saying it's going to be worth something in 2030, which feels like a long way off for investors. So I think investors are doing the right thing today by using their liquidity and exiting the shares until it is clear what the value of either the core business is or the value of those metaverse investments are, both of which are really hard to value today.
Yeah, certainly a steep fall from yesterday when you look at where the stock is down right now. Laura, always good to get your insight. Laura Martin-Needham, internet analyst there. Well, it's clearly been a rough week for big tech as economic headwinds make its mark on corporate results, but the week is not over yet. We've got two big ones on tap today. Apple and Amazon next in line to report their results. Let's bring in Yahoo Finance's Ali Garfinkel, who is looking ahead to the big numbers coming out after the bell today. Ali.
You're right, Akiko. It's been a rough week, but it's not over till it's over. We have two huge names here, right? First, we have Apple. What are analysts going to be looking for? And the big thing for Apple today, I think, is going to be iPhone sales, Akiko. If you recall, a little while back, we got those reports about weakening iPhone demand and the company pulling back production. The Apple stock went into a bit of a tailspin and has since recovered. However, that is going to be the thing that investors are looking at, spotlighting. Can the company, in this consumer slowdown, show that iPhone sales are resilient? So that's Apple. That's going to be a huge one. And on the other hand, we also have Amazon reporting after the bell. And for Amazon, it's actually going to be, in some cases, a similar story. Analysts are looking for AWS growth. They're looking for retail sales. The company is coming off two prime events in recent months, and there is hope that those prime events are really going to boost some of those numbers. But it remains to be seen, right? This has been an incredibly difficult week for not only for Meta, for Microsoft, for Alphabet, across the board. Those headwinds, whether it's Forex, inflation, a hawkish Fed, consumer slowdown, you name it, it has hit just about everybody. That said, there is some optimism from what I've gathered from sources. You know, JP Morgan is saying that Amazon is its best idea in tech right now. And Wedbush's Dan Ives does believe that we could see some wins out of Apple today. So I'll keep you posted after the bell, but there is still some hope before this week ends.
Okay, certainly investors looking to end things on a positive note, at least with these tech earnings. Ali, thanks so much for that. Well, strong quarter is helping lift shares of Caterpillar. We are seeing a big pop there, up more than 8%. This is a company we often turn to as a bellwether for the broader economy. It earned $3.95 a share on revenue of $15 billion. That marked a 21% jump from the same period last year. The Texas-based equipment maker facing rising material and higher freight costs, but greater equipment sales and higher prices helped offset some of those inflationary pressures. The firm saying that it expects price hikes in the fourth quarter to more than offset higher costs in manufacturing. Well, coming up, temporary relief. The U.S. economy posts positive growth for the first time this year, but much of it down to the one-off impact of a narrowing trade deficit. So the recession is still coming, right? That's what a lot of people are asking today. We'll try to answer that question for you on the other side.
Now, メルカリに招待した人された人に合計4000ポイント。2人分合わせて4000ポイント。
food prices, supply bottlenecks, and the post-pandemic recovery in demand have led to a broadening of price pressures and an increase in inflation.
That was ECB President Christine Lagarde setting the table for why the central bank doubled its key interest rate. The remarks at the press conference following its decision to hike by 75 basis points. Let's bring in Yahoo Finance's Jared Blickery, who's on top of all the big moves coming on the back of this. Jared.
That's right. First thing I want to point out is that the euro is net down after the move. Let me just show you the intraday price action since midnight. And you can see we got some fireworks here, but right around parity with the U.S. dollar. As you said, Akiko, Christine Lagarde and company doubling the short-term interest rate there to 150 basis points. But the outlook for the future not quite as hawkish as the Federal Reserve. At least that's what traders are saying right here. Now, let me put a 3-year chart, and you can see clearly the euro is still in a very firm downtrend. As I pointed out just a second ago, it is at parity with the U.S. dollar. Now, overnight, we are going to get an interest rate decision from the Bank of Japan. And let me show you what's been happening over the last 3 years with the U.S. dollar versus the Japanese yen. Dollar has strengthened appreciably. Here is a year-to-date view. And then over the last 7 days, this is going to show that supposed yen intervention that happened last Friday when, Kiko, you and I were calling this in real time as there was something underfoot in the market. And you can see the dollar net down since then. That is a market departure since the last time there was an intervention by the BOJ over there. You can see not really having much effect. 2 weeks later, that high was taken out by the U.S. dollar. We'll have to see what comes tomorrow. Kuroda, as we have saying, he is the BOJ head there. He's out next April, and he has doubled down on his strategy, standing by yield curve control. We'll have to see if the market forces his hand overnight.
We'll be watching. Thanks so much, Jared Blickery. Let's take a closer look at some key stocks and sectors. Our next guest is seeing value in web browsers, Coke bottles, and fracking suppliers. Here with more is Brian Frank, CIO of Frank Funds and Frank Value Fund Portfolio Manager. Brian, thanks so much for joining us. You were basically saying that tech, as you see it, is cyclical. So what? Tech out, value in.
Yeah, absolutely. We feel like this is the golden period for value investing. It looks like it could be a lost decade for index funds because they're heavily weighted towards tech. And tech is very cyclical. People don't tend to realize that when they get excited about all the growth that happens in tech. But as we've seen with Meta and the other earnings reports coming out, it's pretty cyclical.
What do you make of this divergence that we're seeing? I mean, you mentioned during the break that it's interesting to see how even with disappointing earnings coming from these mega tech names, that's not necessarily dragging down the rest of the market. That's a bit different than what we have seen in the previous quarters.
Oh, absolutely. And I think it's kind of a sign of healthy market function. The market actually cares about fundamentals again. The last few years, it was just about what's the Fed going to do to make everybody rich and drop money from the sky. And now it's about, oh, is your company actually profitable? Are you actually growing? And that's a sign of good market function. However,
At Barclays Corporate and Investment Bank, we're powering possible for clients, providing real results, create.
of high inflation fall heaviest on those who are least able to bear. Restoring price stability will take some time. It requires using our tools forcefully to bring demand and supply to better balance.
I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna on a big screen, you and me together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Lying in the long grass, watching as the clouds pass, hands held in silence. Your arms right around me, feeling glad you found me, feeling like I'm home. Wish you would remember April to September, wanting to be near me. Waiting for the sunrise, staring into my eyes, you and I alone. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. up a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely up a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Couldn't be so easy just to walk away. Was it so wrong? You know you said you loved me. Couldn't be so easy just to walk away. Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Lying in the long grass, watching as the clouds pass, hands held in silence. Your arms right around me, feeling glad you found me, feeling like I'm home. Wish you would remember April to September, wanting to be near me. Waiting for the sunrise, staring into my eyes, you and I alone. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Lie back in my own dream, play back on a big screen, you and me together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. playback on a big screen, you and me together. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Lying in the long grass, watching as the clouds pass, hands held in silence. Your arms right around me, feeling glad you found me, feeling like I'm home. Wish you would remember April to September, wanting to be near me. Waiting for the sunrise, staring into my eyes, you and I alone. I wish that I could tell you. I wish that I could tell you. I wish that I could what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. I give up a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? You know you said you loved me. Couldn't be so easy just to walk away. Was it so wrong? You know you said you loved me. Couldn't be so easy just to walk away. Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. The nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Lying in the long grass, watching as the clouds pass, hands held in silence. Your arms right around me, feeling glad you found me, feeling like I'm home. Wish you would remember April to September, wanting to be near me. Waiting for the sunrise, staring into my eyes, you and I alone. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely give up a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Was it so wrong? You know you said you loved me. Couldn't be so easy just to walk away. Was it so wrong? You know you said you loved me. Couldn't be so easy just to walk away. Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jump into my car seat, drive down to the river. Nightlight is reflecting, somehow I'm expecting your voice in my ear. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. I give up a love found, wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl. Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Was it so wrong? You know you said you loved me. Could it be so easy just to walk away? Staring at the top sheet, listening to my heartbeat, wondering how to say it. Playing over one track, wanting you to come back, want to have you here. Lying on a cold sheet, jumping back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely Lying in the long grass, watching as the clouds pass, hands held in silence. Your arms right around me, feeling glad you found me, feeling like I'm home. Wish you would remember April to September, wanting to be near me. Waiting for the sunrise, staring into my eyes, you and I alone. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that lie back in my own dream, play back on a big screen, you and me together. Why give up?